Thanks for tuning into the trades to India Market Open, excuse me, with me, Niraj, and Agam Vakil with me today. And Agam, it's an interesting day of trade simply because there's just so much happening today, right? I mean, there's the CPI data from US, India, China, the FOMC, and well, lots more. So it's a packed day today.
Yeah, it's a packed day today. And, while a lot of traders are saying that there aren't enough triggers, I think there are plenty to keep an eye on still. And I reckon that the Federal Reserve will be at the top of everyone's mind today.
Yeah, so it'll be interesting. A bit later on in the show, of course, we'll try and get you views from Arvind Sanger because he tracks it so closely. So I think that will be important. But let's take stock of the global news flow first before we talk about our markets. So just a quick snapshot of what the US markets did and what Asia is doing as well. Remember, Asian stocks have slipped. But the US markets, NASDAQ was okay because Apple powered this. So Asian stocks slipped with the US CPI and Fed in focus. Keep an eye out on the Bloomberg Dollar Spot Index, which rose on Tuesday for the fourth session consecutively. So therefore, DXY is something you ought to keep in mind. Apple was up and about, and while Elon Musk may not like Apple integrating OpenAI, Apple shareholders as of yesterday, were very, very happy because it popped 7%. And I just wonder if it makes the race with NVIDIA even hotter, Agam, because NVIDIA powered past Apple quite convincingly, and Apple trying to make a comeback, not from market cap raise perspective, but just makes it so tantalizing, which is doing what?
From an Indian investor perspective, all those who are in fact invested in the NASDAQ ETFs, they are happy if NVIDIA wins or Apple.
Exactly.
At the end of the day, is what the big takeaway is. But is there anything else that we are keeping an eye on in global cues?
No, just oil, Agam, is interesting because 2 days on a trot now, oil has moved up. It's held the gains as that IEA report points to lower US stockpiles. Maybe that plus OPEC is saying that they expect demand to be steady. So maybe the downdraft that we saw for the last few days in oil gets corrected. Hopefully it doesn't spike too much, but currently about 80. Sweet spot, nothing alarming. Let's wait and watch.
Right. And of course, it will have some sort of an implication in Indian markets. Long term, indirectly, of course, we'll continue to track that. But, in terms of domestic cues, what's really happened over the last 2 to 3 sessions is consolidation on expected lines now that we have the big events behind us. And at the moment, what we're looking at is a little bit of a sideways movement. So in general, we're not even expecting a very huge spikes. And even though we still have a handful of events that we need to still keep an eye on, at the moment, we're expecting not too much in terms of an intraday movement. That said, it is still the Bank Nifty weekly options expiry. So can't completely rule out choppiness. But overall, it's going to be, a relatively quiet day, as has been the case for the last couple of sessions as well. Well, what we have seen in terms of the range, at least based on certain technical levels as well as your option market and where that has been distribution, is a 500-point range for the Nifty, 23,000 on the lower end, 23,500 on the higher end. And in general, we still don't have as much in terms of longs from an FII standpoint in index futures. Their longs still stand at just about 36%, and there is further scope for things to improve. The other takeaway is, as far as cash markets are concerned and what FIIs have been doing over the last 5 days, things have changed a little. The last 3 days specifically, notwithstanding the 101 crore outgo from FIIs, there's been buying which has been returning. And of course, the reason why I consider just the last 5 days is because the 4th of June was a day where we saw a dramatic change. And since then, we have seen recovery of sorts. In fact, the Nifty climbing over 23,000 and making new life highs since then as well. So a lot of that volatility is out of the way. And now the question really is that are FIIs going to be back and going to be buying into markets, into what is perceived as in general, a continuity in policies as far as the markets are concerned. But on the whole, Niraj, we'll continue to expect consolidation in Indian markets for now.
Yeah, I mean, and nothing more to add to that, but for the fact that we kind of try and point out pockets where could be strength as well. So before we get to specific stocks, Agam, could be interesting cement today, right?
Yeah.
Motilal Oswal coming out with a note and saying that watch out because There is a cement price hike that has happened in the month of May after multiple failed attempts. Now, wonder if that brings about that bit of a spurt. And the note very interestingly also says that after a muted growth in April, cement demand improved month on month in May. Now, we know that because of Achar Sanhita or the election code of conduct, there isn't too much in terms of announcement of infrastructure projects that the government does. And while this is monsoon, but if the government comes out and does some announcement around infrastructure, etc., then all of that could be very, very interesting for the cement companies as well, especially if it's done down south where the monsoon comes in a bit late. So very interested to see if some of the cement counters in particular do well. Yesterday we were talking about oil being in focus. Is today cement's day is the question.
And we very well could expect a little bit of a turnaround in the sector since it has been relatively quiet, and these price hikes which are on the cards could potentially change things. Of course, monsoon becomes a crucial point for cement sector as well in terms of seasonality. So very important to keep an eye on that one. Well, I have three other relatively smaller stocks on my radar this morning. The first one is Action Construction. This has been the HNI favorite of late. It's been trading at pretty heady valuations, but from what we understand is that yesterday it was under pressure, and now we get to know that promoter Mona Agarwal has sold about 1% stake in the company at around 1,420 odd crores. This was at a discount to Tuesday's market price of maybe up to 1%. It's not that significant. And well, the promoter holding, as far as Mona Agarwal is concerned, still stands at a little short of 25%. We move on to Dollar Industries, and again, this is a sector which is now starting to see some volumes return, and by that I mean the share price or volumes. But the company has said that they are bullish on South Indian markets at the moment, and they've recorded their highest turnover in FY24 at around 1,550 odd crores. They are opening 50 exclusive brand outlets across India, and they're looking to do that by 2027, and the group is also targeting growth of around 11 to 12%. That has been a relative standard for the entire industry as a whole. So it's not just Dollar, it's Rupa and Company, Lux Industries, and some of your relatively smaller names as well. And the next one, of course, on my radar is NHPC. Now, we understand that the National High Power Test Lab has approved a transfer of about 1.3 crore shares to Power Grid, and NHPC stake in NHPC's NHPTL now stands at around 12.5% from 20% earlier. So there's been a little bit of dilution there, and which is why we could see a little bit of a reaction as far as NHPC is concerned. Niraj.
Okay, so well, some interesting names as out there. I reckon Tata Motors could be in focus as well. On the back of the Investor Day update, they're aiming for 10% EBITDA for console PV EV ops by FY30. They aim the EV business to break even in FY26, and they expect the CV cycle to continue for a long period of time. They also target PV margins of about an uptick of about 200 basis points in the coming years. And most brokerages seem to be sanguine about what Tata Motors could do. So the target prices stay higher. They're saying Tata Motors, Morgan Stanley, I think, for example, has said that Tata Motors usually is delivering on its promises. So this shouldn't be too different either. Watch out. The stock has had a terrific 2023, not as strong 2024. So the YTD gains, for example, pale in comparison to what the stock did in 2023. But no complaints whatsoever. I think the other large cap which will be in focus today is HCL Tech. This company signed a $278 million contract or a deal with Germany's largest cooperative primary bank, Apo Bank, for 7.5 years. Now, viewers, why is this important? Because one, it's an existing client. So HCL Tech has deepened the relationship with the client, which is good news for them. Two, in the absence of any kind of discretionary deals that are coming in the way of IT companies, for them to announce a large deal probably gives a bit of visibility and confidence that HCL Tech might be able to meet the guidance that it has laid out for FY25. I think most brokerage notes are of this view as well. So do keep an eye out for HCL Tech amongst the large names. And just one more stock at mine. Maybe I have a few more, but Agam might have a few more too. But I don't quite know if BL Kashyap has a positive or a negative in the session today. Now the positive is that for a company of its size, it's 2 new orders aggregating to about 1,021 crores approximately. Now, this is large because its order book before this was 2,500 crores. So it's a very large order win for BL Kashyap. But SEBI summoned the company. And in the release that the company is given on the exchanges, they have not disclosed the nature of the investigation by SEBI. Usually, this would outweigh the positives of an order win, I would reckon. So, very likely that the stock could have a negative reaction today. But let's wait and watch. At times, funny things happen as well. So the top 3 on my radar were this. I have a few others, but Agam, anything else that you're spotting?
Yeah, I'm going to, again, talk about a handful of other small names. And TVS Supply Chains is one of them. Now, it's actually signed a 5-year contract with Daimler Truck. And the key takeaway is that this is a 5-year contract. And because of that, it does provide a little bit more visibility as far as the company is concerned. In fact, we spoke to the company about 3 weeks ago, and they have not only maintained that they are going to keep on their 7% to 7.5% margins, but they are expecting better growth as compared to what they have already seen back in FY24. Of course, it's a relatively smaller company. There is a lot more scope to grow, and the company is also suggesting that, well, given the kind of markets that they operate in fact, it is this relatively large enough for even competitors to come through. So for now, they're not too worried about competitive intensity. And besides TVS Supply Chain, the other stock on my radar is also Vodafone Idea. We understand that it has lenders in principle approval for 14,000 crores, from SBI-led consortium for the 5G rollout. This is, of course, a report. These are news reports which suggest the positive. We've already seen a positive tick in Vodafone Idea. In fact, it has moved up from the mark of around 12 to 13 over the last few weeks to all the way to 16.5 at the moment per share. So these are the other 2 stocks that viewers may also want to keep on the mind.
And the last set of names from my end before we get into Arvind Sanger, who's with us. A great day to have him. So Quant MF usually being active has resulted in some reactions to stocks, but these stocks already moved up. So Om Infra, wherein Quant MF bought about 17 lakh shares at 130, was up about 5%. The other one is Adore Weldings, wherein the manufacturing fund and the PSU fund from the Quant MF stable bought some shares, and the stock was up about 14%. So pretty strong move up already. Remember, the Quant's buying price is 12.55. So if you are a kind of investor, you shouldn't be, but if you are, who follows what large investors do blindly, then the stock price has already reacted, keep in mind. If you do study Adore Weldings and buy it, then that might not be a bad idea. And the last one, Agam, is Word Wizard. Now, it's a small company, viewers, 1,900 crores market cap, trading at TTMP of 130 times. The curious thing is this. A day ago or 2 days ago, Word Wizard came out with a press release. In the press release, they said they have won an order of $1.29 billion or $1.19 billion, as the case may be. Then, in the details, they say it's an MOU. So it's not an order win. It's just an MOU. And very curiously, in the last 2 days, the promoter entity of Word Wizard has gone out and sold some shares. Now, I'm not alleging, because I do not have details. We placed a request for the management to come in and say why is it that they had this called an MOU an order in the first place, and 2, if indeed the future is looking so bright that the 2,000 crore market cap company has won $1 billion MOU or an order, why is it that the promoter entity is selling? Their shareholding is not above 75%. They need to bring it down to meet the SEBI requirements. So a lot of you must be trading into some of these stocks. I just thought it was important to highlight that there are some in which things are happening for which some clarifications might be needed. So be careful if you're trading this one. Again, I repeat, we're not saying anything that the management has done which is untoward, par for the course, well released, etc. But the sequence of events is interesting. Let's wait and watch what the management has to say for this.
Right. Well, there you have it. But let's move on and get in a special voice now. Well, we have Arvind Sanger, managing partner at Geosphere Capital, who's joining us here in the studio. Arvind, thank you so much for taking the time out and speaking to us here at NDTV Profit.
Thank you. Glad to be here.
So, Arvind, we had you here about a few months ago. And of course, back then, things were maybe slightly different and still the same. At least as far as the political scenario is concerned, well, we now have clarity as to what we can expect as far as government policies are concerned. A continuity is what we are looking at. What's the way forward from here, considering some of these aspects there?
Well, so let me take a global perspective and then let me come to the India perspective.
Sure.
So from a global perspective, we've gone through 2 or 3 rounds of will they or won't they in terms of Fed cutting rates. So, every new data point brings a new discussion. Today we'll get in USRs, we'll get the CPI, then we'll get the Fed rate decision, then we'll get the press conference. So there'll be some volatility around that. My view is on a global basis, we're in a cutting cycle, but I think the cutting cycle is going to prove to be less deep than people expect because inflation on a global basis is going to prove to be more sticky than people expect. So that's the backdrop from a global investor standpoint when looking at risk tolerance. So my view is if inflation is coming down it may stop at 3, 2.8 and not go to 2. I don't really care. It's not the end of the world. Right. In that environment, how does India look? And, I think you were talking about World Bank forecasts. Our assumption is, if we get 6.5%, 7% GDP real growth, we get 11, 12% nominal growth. We're looking for companies that can grow top line at 15% plus and grow earnings at 20%. The biggest challenge that we face in looking at India right now is valuations are not cheap. So therefore, it's not a multiple expansion story. It's an earnings growth story. And finding those companies, and that's what this trip is about. It was planned to come after the election so that would be out of the way, and then talking to companies and understanding, because it's not really the politics that's going to drive, as long as there's continuity, which there is, it's going to be individual companies and subsectors' ability to execute. And that's what we are looking at where we find opportunities.
Okay. Arvind, just good morning, of course. And just wondering, can the Fed commentary lead to any kind of issues for risk assets by and large? If indeed they rule out rate cuts for the rest of the year, is that baked in already? Because some people say that we expect only in 2025 and nothing in 2024. But if they formally say something to that effect or indicate something to that effect, could it mar risk assets by and large? If they came out that definitively, it would. But I doubt that they will put their neck that much on the line. They will probably say that it's data dependent, data is getting better. The question is dot plots, which is kind of where the rubber meets the road. And will the dot plots still show 2 in September and December, or will the dot plots show only 1? I very much doubt it'll go to 0 because there's not been that bad data. So that 2 or 1 can cause near-term volatility, but the reality is what's going to matter is the data. Today's data on CPI, next month's data, whatever. There's a lot of data that'll drive the decision. There's one thing that is really not getting enough attention. There's something called a Psalms rule, which says that when unemployment in the U.S. goes up by more than 50 basis points, it is usually a sign of a recession. Unemployment has gone up over the last few months by about 70 basis points. So far we're seeing no signs. But let's not assume that we're going to get this immaculate landing, that we land at 2.8 and then the Fed cuts and everything is hunky-dory. There's a risk of a recession. So we don't know. But to your original question, I don't think the Fed is going to dump on the party in a way that would, I think, Powell is very much, market-friendly in that respect. Got it. You raised this question around India and the valuations thereof. Always been expensive, right? So we never find a cheap, except for maybe the COVID lows. We never find India to be cheap. So no, that's not the history. The Indian market, you can see there are ranges of valuation, but in the last few years, you're right. Yes. So exactly. Recent history is anything to go by. So my question is, if from a large markets perspective, India and the NASDAQ are the only games in town, will India, and maybe Japan, of course, will India continue to remain expensive? I suspect, barring any major shocks globally,
it should remain expensive, which is why we're not counting on a multiple decline.
Okay.
We're not counting on a multiple decline. We're just looking for growth stories and finding growth stories which are not fully discounting that growth. Because right now you find companies growing at 25% earnings, trading at 50 times on a PE multiple. So that's not kind of where we're looking for. We're trying to find growth at a reasonable price, and that's the tricky part in India, finding companies that fit that bill.
Okay. Right. Arvind, how much importance are you placing to the India interest rate trajectory at the moment in your anticipation here?
So look, it's clear that RBI, first of all, has done a really good job in terms of managing the inflation cycle.
Yeah.
So inflation has come down quite comfortably. But I think also RBI doesn't want to step out and be first to go in a global environment. Now, you've already had ECB. You've had ECB go. You've had Bank of Canada go.
Right.
So somewhere here, I think there is room for the for the RBI to start easing. I'm not sure how quickly they'll do it, but I'm not counting on a huge easing cycle. I think it is good that RBI has remained vigilant, and of course we have now monsoon, so we'll have to watch for that for inflation. But I'm optimistic that there is some support coming from there. How big, I don't know yet.
Right. And, valuations aside, just talking about growth, and if we could just consider the relatively larger names in the universe, the Nifty 50, do you think that growth can come through? Would it be single digit? Would it be double digit? Is there a possibility?
I think earnings growth, if we have nominal GDP growth of 11% or so, I think good private sector companies should be able to show top line growth of 15%. So that's not out of the question. And in fact, some of the better values actually lie in some of the large caps. And, financials is one of the areas where we find some opportunities because, again, we had some short-term problems, loan to deposit ratio and other things. But if we are believing in this economic cycle and we're believing that the private sector is going to, at some point, take on the baton from the government, which has done a great job on infrastructure, then some of the banks will be important in funding that growth. And so therefore, the financial sector is one that has remained, at least some of them have remained somewhat laggard, and we see opportunities there.
Yeah, a bunch of mutual fund schemes also getting launched out there. So within financials, are you preferring the private banks because the valuation multiple within the PSUs have narrowed? Or could it still be a year of PSU banks outperforming private banks? I mean, the profit pool of the PSU banks has expanded dramatically over the last 3 years. So they're doing something right.
Yeah, no, I must admit that I've been favorably impressed by the PSU banks' performance, which is not something that they have had a consistent track record of doing. I think there's opportunities in PSU banks, yes, and finding the right one with the right trajectory. But I think there's also opportunities in some NBFCs. The RBI has been cracking down a lot on this arbitrage between the two, but there are opportunities in some of these sectors, which again, there are some that are coming out of problem areas and seeing opportunities to grow. So I think the financial space has so many angles to it.
Exactly.
That is not just ICICI, HDFC, SBI. There's also a lot of both public sector banks that you're mentioning, and there are some interesting NBFCs that I think could be interesting in this cycle.
Yeah, so the ones that are coming out of hit, so it could be gold loan, it could be consumer finance, it could be housing loan.
Yeah, all of those could be interesting. Yeah, valuations are interesting.
And just one follow-up before I hand it back to Agam. Non-lending financials, I mean, that's a story that's really come of age in India. Do you like that pocket?
When you're saying non-lending, you're talking about fintech type of companies?
Or even the capital market players, AMCs, brokers, the infrastructure providers like CDSL, CAMS, etc.
We haven't looked at those. We're meeting with some on this trip, so I hope to have a better answer to that question. But, look, the financialization of the Indian economy is on a very strong trajectory. And therefore, finding ways to play the winners of that financialization. I mean, we've actually, we've been big bulls on the commodity trading. So, MCX has done very well, but we didn't see how BSE with the options trading. Now, the thing that I worry about with a name like BSE, I have no edge, is that the retail participation is a little too frothy.
Right.
And whether the regulator, who's been cracking down on a lot of other things, might puncture the balloon, I don't know. So I prefer to play in less frothy areas of the market where things are not quite as go-go as they are in some of these corners of the market.
Yeah. Interesting. It's interesting that you mentioned that as far as BSE is concerned, because we have mixed views on the regulator and the allowing of a lot of these retail participants in derivatives specifically. But I'm going to come back to the objectives of your trip this time, Arvind. What are the specifics that you have in mind? What are you keeping an eye on for your plan here right now?
Well, I don't have any specific theme that I'm meeting companies across a whole set of sectors, and just trying to get a sense from companies in different, whether it's financials or it's consumer or it's tech niches in Bangalore or whatever, or auto related, just trying to get a sense from individual companies of their own positioning. I'm not, and I may go stop over at one of the conferences to get a view on the macro, what's going on. But the whole idea is to get a pulse of not the macroeconomy. The macroeconomy is so big that I'm not sure that any one company can give you the pulse, but get a sense of where some of the emerging ideas might be, and more on the mid cap and a few large caps thrown in.
Right. And do you have an idea in terms of which of these areas and what sort of mid caps are you looking for? Perhaps sectors, perhaps things?
I think the whole renewable green technology. Try to find areas that could benefit from that. There's a lot of froth, right? There's a lot of froth on anything that I say. There's already froth. But some of the NBFCs that are kind of been left behind that area, and then looking at some niche companies in. Chemicals related sectors which have suffered. So trying to find different areas where there's not as much froth and trying to look at those. So there is no big theme in the portfolio, but it's always useful when I come back from these trips. I get some ideas, and then today's Zoom world, people that I don't get to meet on this trip, I'll be following up with in Zoom calls in the future, and this becomes kind of a impetus for companies who couldn't meet this week doing follow-up calls. So I think the benefit of a trip like this lasts for 2 or 3 weeks in terms of continuing conversations.
Okay. I have one final question. You're sounding quintessential value. Where is it that you are comfortable with premium valuations?
I don't know. It's hard. In India, it is hard as a value investor. In my global portfolio, I'm buying companies with 10, 15, 20% free cash flow yields. In India, I have to take that hat completely off and wear a hat of, what kind of earnings growth, and if it's 20% earnings growth, do I pay 25 times earnings, 15 times, 20 times EBITDA? It's kind of a different. So trying to figure out where, because the thing that I have to recognize, and this is part of the challenge as investors, we can get stuck in the mud with one viewpoint, is that with the liquidity coming into the market, we have to accept that there is a theme here which is not going to roll over, and therefore we have to play in that circumstance and find relative value without completely losing sight of the fact that sometimes things can get too frothy.
So Arvind Sanger,
No, I just had one more question on the froth. For the sake of our viewers, if you could just tell us about the areas where you see there's so much fraud that it's actually so risky. If you could just tell us about the areas where, stay away from this.
I'm not sure that there's, I think mid-caps in general have a lot of valuation. We were thinking that, if consumer is going to be interesting FMCG companies, but they all trade at 40, 50 times earnings to start with. So I'm not sure if there is a recovery coming in consumer. How do I play it at 40, 50 times earnings, right? I'm chasing after rainbows at that point. So therefore, some of these areas are hard to chase after with the valuations that they have. IT is it a value trap or is it cheap? Because at the earnings growth that they have right now, they're not cheap. For single-digit earnings growth trading at 20 plus multiples is not cheap. and I see a train coming down the track with AI. So finding those companies that might be able to, I'm looking at more, and one other sector I forgot to mention, healthcare. I'm looking at less international facing and more domestic facing.
Right.
So I'm interested in Indian tech companies which are doing something interesting in the Indian tech ecosystem.
Sure.
I'm looking at healthcare companies, not the traditional pharma companies,
right,
but the ones that are disrupting existing structures of distribution of whatever domestic. So I think that the opportunity is different than what it used to be before, which was these outward-facing IT companies, outward-facing because all the money was to be made overseas. I think there's Indian economy-based winners that could be very interesting.
Okay, well, on that note, we'll thank you, Arvind. And you mentioned 3 weeks to take in, soak in all this stuff. By that time, the budget will be out. We look forward to getting your insights around how you thought about India post-budget, maybe, from the US.
Sure.
Yeah, great.
Thank you.
Thanks for joining in today.
Thank you. Good to see you.
All right. So that's the view from Arvind Sanger. Time now for a very quick break. Up next, we speak to our derivative experts and get you some option strategies and more. Stay tuned.
Welcome back. This is India Market Open. We're taking stock of the futures and options space. Well, consolidation continues. In fact, yesterday the Nifty closed flat with very little change in the respective futures open interest. The Bank Nifty, the picture wasn't very different. That was also marginally in the red with less than 1% added in OI. So it does seem like traders at the moment are sitting on the sidelines waiting for perhaps a trigger to come through, and then that's when they can determine a direction. But for now, this is how things stand. Even in terms of the options market, activity across several strikes has been very, very mixed. We are keeping an eye on your overall open interest distribution picture, which also indicates a 500-point range for the Nifty. Largely 23,000 on the lower end. That's where you have a substantial amount of puts being written. And on the higher end, we have the 23,500 call, where you do have a good amount of open interest distribution. Now, moving on to the Bank Nifty, it is the weekly options expiry. And at the moment, once again, it's the 50,000 mark, which will be a crucial level to keep an eye on, in and around there. And again, on the lower end, keeping an eye on 49,500, which would provide you with some amount of support in today's day of trade. Let's keep an eye. But let's move on and talk about stocks then. And of course, we have longs for Sun TV, GMR Airports, along with Oberoi Realty, and shorts in Interglobe Aviation and PI Industries. Interglobe Aviation, of course, saw a very large bulk deal yesterday, which is why it was under pressure. We had a key investor sell in there. But among stocks which saw unwinding, again, short covering for Tata Chemicals, MGL, Apollo Hospitals, along with Bharat Heavy Electronics. So keep an eye on that one. But on that note, let's get in and expert for today. Well, we have Amit Goel, who's joining us on the show. Amit, good morning. Thank you so much for joining in. Amit, the big events are out of the way. The dust seems to have settled. It does seem like benchmarks are now in consolidation mode. What is your reading, and how are you dealing with these markets?
Yeah, hi. Good morning, Agam, and thank you for having me on the show. Yes, the big event is out of the way, but the market is now kind of consolidating, waiting for certain key triggers, including the CPI data as well as the Fed data, which is due to the evening and tonight. So until we get a clear direction from those two major data points, I don't think the market is really going to be trending today. Having said that, I do have a slight bearish tent on the market, and I would look to probably sell the 23,500 calls for this expiry just to earn a little bit of income on the trade. But I will keep the yesterday's high as a technical stop for that kind of a trade on Nifty.
All right, but you have a structure that you're deploying on the bank Nifty as well at the moment?
Yes, Agam. So I have a volatility arbitrage trade on Bank Nifty. I'm not really looking at playing the direction, but having said that, I do have a slight bearish trend to it. If I look at the forward volatility calculation estimations across the term structure, I find that the 49,000 strike offers me a decent vol arbitrage for the 26th and 19th expiries respectively. So what we would like to do is, if the market trends around in the range of yesterday's candle, we will look to buy a 49,000 put of 26th expiry, one lot, and sell the 19th June expiry of the same strike, which is 49,000. We will try and enter the trade having a maximum debit of about 2,400 with a margin of 24,000 rupees. The initial profit target here would be about 1,000 rupees per lot, Agam, which works out to a cool 3.5-4% on the trade. We will also keep a rupee stop loss of about 1,000 rupees per lot, or we could also have a technical stop if the price closes above 50,000 levels by, say, Thursday. If the market starts to trend on the upside, we could look to close the trade for a smaller loss. This is the trade for Bank Nifty.
Okay, so the logic behind this specific trade is very simple. In fact, you sell an implied volatility which is very high, and you buy an implied volatility which is very low. And what Amit is also doing is that he is dealing with the very same instrument, but the only difference is that he is dealing with across two different expiries. So it is the 49,000 put in which he's buying the 49,000 put of the 26th June expiry. That's because implied volatilities for that specific expiry are low, which is why he's buying them. And of course, simultaneously, he is also selling the 49,000 put. This is the 19 June expiry. Why? Because implied volatilities are higher. And when he says he is playing an volatility arbitrage, this is what he's doing. He's trying to look and make the difference in terms of implied volatilities. As we all know, implied volatilities are nothing but a reflection of option premiums. And that's exactly how it plays out as far as this specific strategy is concerned. Amit, if I'm correct, and if there is any more additions, please go ahead and make clarifications.
Yeah, so there is one small addition which I'd like to make. You've already put it very elaborately and succinctly. What I'm also looking at is I'm trying to estimate the volatility, what it is going to be between the two expiries. And since my estimation, which is known as the forward volatility, if my estimation is that that is going to increase, I'm trying to play this as you have said, that here I'm selling the higher volatility and buying the lower volatility. That's the only addition.
Okay, fair enough, Amit. But I suppose you also have ONGC on your radar. Can you tell us about how you're playing this one?
Yeah, this is a pure momentum play, Agam. As we have seen that ONGC has been moving up very sharply, and there is some strong price action coupled with long build-up in the F&O data. It also gives some support for the bullish view. If you look at the cash volumes yesterday, that was also very interesting, and we have had a very strong volume in the cash market as well. So looking at the F&O data and the cash volume surge, along along with the price, obviously with the price action in mind, I'm looking to build a bull call spread in ONGC, in which we will, if the price trends between 270 and 275, I will look to buy the 270 call and sell the 275 call of June expiry, ensuring that the net debit does not cross 5,000 rupees per lot, which also happens to be our max loss in the trade, the theoretical max lot. And we will keep a rupee stop loss of about 2,000 rupees per lot, and we will keep an initial profit target also of about 2,000 rupees, making this trade also a 1:1 RR. And once we achieve the 2,000 rupees profit, we will trail for bigger profits. The margin in this structure is also going to be about 24,000 rupees per lot. So this the view here gets negated if the price action does not support the OI and cash volume surge data, and it trends below 265, which happens to be yesterday's low. So this is a pure momentum play on the ONGC.
Absolutely. And, once again, to revisit the difference between playing a bull call spread and a futures is that to a certain extent, and please, I do mention to a certain extent, a bull call spread also plays very close to a futures. But after it reaches a certain bound, the returns in a bull call spread are not as much as one that you may get into futures. Similarly, on the downside as well, your downside is capped in a bull call spread. And of course, in a future, it is, it could be as low as the stock could go. So that perhaps is one of the advantages of playing a bull call spread in this case. Amit, a final question on the overall view on the markets. And I know this is slightly out of the syllabus, but just to follow up. Now that we have a lot of events out the way, and in general, just to take a view, do you think that consolidation could be on the cards based on your experience over the next 2 to 3 weeks?
Yeah, I agree. Consolidation seems to be the theme that is playing out after the conclusion of the big event, and things have fairly, barring the 2 days of extreme volatility on the exit poll day and the election result day, we have kind of more or less resumed the trajectory. I do see that there is some bit of resistance at higher levels of 23,500 on the broader index, and till we see any major triggers, I would say that probably if inflation data comes in better than expectation, we could see an up move resuming in the market, and if the inflation data does not come as per expectations, we probably might see a slight bit of retracement in the market. But having said that, I don't see any major trend forming in the market till we hit the results season in the next. So June would probably be a sideways or a consolidation theme to be played out, and we should, as traders, look to capture this on the relatively still high IV levels, and probably look to set up non-directional strategies, or if you are well versed with it, probably a volatility arbitrage strategies.
Fair enough, Amit. We'll leave it at that. Thank you so much for joining us and giving us your views on the markets, and also handing us a handful of option structures that we could potentially deploy. With that, it's back to you, Niraj.
Thanks, Agam. And well, option strategies, some data points around trade, and earlier on in the show, a lot of stocks that should have been watched out for as well. We'll revisit some of those. For a lot of you who are tuning in right now, we'll cover most of the stocks that should be in focus today. Let's start off with the big one. And I think the big one is Tata Motors. A slew of they had their annual investor day yesterday, by the way, and a slew of brokerages have come out with their notes post an annual investor presentation. Puneet has scanned through all of those. He had looked at the presentation as well, and he joins in with all those details. Puneet, good morning.
Hi Niraj, good morning. So what we've done is effectively, just take all the brokerages and divide it into categories wise of the company which it operates in. So for passenger vehicle, we've seen really strong commentary from the management as well as brokerages. Market share of Tata Motors has gone up from just 5% in FY20 to all the way to roughly 14% now. The company has said that they're expecting to increase this to 18 to 20% by financial year 2030. Now they've also said that they are looking to increase their PV industry nameplates or new launches across CNG, passenger vehicles, petrol and diesel as well, by 2 times over the next few years. This will also increase the addressable market to roughly 80% of the total industry from just 53% now. So they will be looking to enter compact SUVs, and they will be also launching multiple new electric vehicles in the SUV space as well. When you look at the PV margins, they have risen to roughly 7% in FY24, and the management has guided for this particular margins to reach 10% by 2030. Jefferies has also said that new launches in this particular year will be in the mid SUV market, where we've seen Mahindra come out with the 3X. So the Curve petrol as well as the EV is expected to launch this year, and one of the key launches, which is the Harrier EV, is also expected to launch this year. 2 more products, Sierra as well as Avinya, they've said that these will be EVs launching in the next particular year. When you look at commercial vehicles, they have said that most of the CV industry disturbances have been absorbed, and the company is expected to grow between 4 to 9% over the next few years until FY29. Nuvama has said that CV volumes will be slightly moderate in this particular, but are expected to grow by next year, and EBITDA margins will be in strong double digits. Currently, they are in the low 10 to 11% range. On EVs, this is very, very interesting. The company is saying that EVs will form 30% of their total portfolio. They form roughly 13% now, so really strong traction going forward until 2030, and profitability will also be one of the key targets. They are expected to break even in the electric vehicle business by 2026. They are also expecting double-digit margin in the passenger vehicle space in this particular way. Now, future guidance, they have said the new non-vehicle revenues will be 20%. This will be largely from accessories and other verticals which are sold for commercial vehicles, and also saying that the share of CNG and EVs will increase to 45% from 29% currently. Finally, demergers will be a much bigger logical step going forward as well. And quickly, if I can just say the target prices, MK has upgraded the stock to an add from reduced. Target of roughly 1,050 rupees. Jefferies maintains a buy with a 25% upside from current levels at 1,250 rupees, and Morgan Stanley coming in at roughly 1,100 rupees. So overall, really strong picture coming in from all brokerages across categories. Back to you.
Right, thanks for that, Puneet. So that's the interesting one on Tata Motors, that the big one, which is in focus, in addition to HCL Tech, which we will talk about. But before we try and talk about some of the other stocks, also hear some big voices. Let's listen into why Morgan Stanley's Ridham Desai is constructively bullish on the railway sector, and why Sridhar Sivaram's view on the power sector is constructive as well.
The key infrastructure sector that I would be constructive on is railways.
Yeah.
Because that's where all the heavy lifting is going to happen. The endeavor is to lower India's logistics cost maybe by 30-40% over the next 5 years. And therefore, the happy news here is that we have continuity in the railways, because the outgoing minister and the incoming minister has already done a lot of work in the last 3 years. We wrote extensively about this about 6 weeks ago, about all the changes, and it's dramatic. I remember we had written a report in 2015. The average speed of a cargo train in India then was 20 kilometers an hour. You could cycle faster. Okay.
Yeah.
We've already come a long way from there. Okay. Now that speed has doubled, it will double again. So if the cargo, now think about the macro and the micro implications. If cargo on the trains is moving faster, it becomes cheaper to transport goods point to A to point B. Importantly, the inventory in the system goes down. Okay, so balance sheets become better. This is about ICOR. You need less capital to grow your business. So the implications in the next 4-5 years will unfold and surprise us onto the upside.
Wind capacity is roughly 45 gigawatts. We'll roughly double in the next 4-5 years. Our solar is around 70-75 gigawatts. We'll triple in the next 4-5 years. Our thermal is around 220 gigawatts. We'll add about 40-50 gigawatts here in the next 4-5 years. All this is substantial.
Yes.
And all of this will require power evacuation. You need T&D. You'll need, wires. You'll need transformers. So I think the entire ecosystem will do well. It's left to individuals to figure out what they want to play. I think the entire ecosystem has a lot of opportunity from here on if these numbers were to play out. And looks like they will, based on the commitment that the government has, based on the commitment that private sector is showing.
Okay, well, on that note, let's get in our experts for today. We have Sudeep Shah, Deputy VP, Head of Technical and Derivative Research at SBI Securities, and Niraj Joshi, Head of Research at MarketSmith India. Welcome to the show, both of you. Good morning. Sudeep, I start with you. Your view on the benchmarks. How are you playing them?
Good morning, Agam. See, the last 2 days we have seen markets in a tight range. We have seen consolidation at higher levels, and that is quite acceptable given the close that we had in the previous week on Friday, 23,290. Week on week, we gained 3.5% last week, and despite all this volatility regarding the elections that had happened last week. So, post that, I feel some consolidation is a given. And especially when tonight the US CPI numbers are going to come out, the Fed policy outcome is going to be announced. So before that, I feel that the markets are going in light. What is happening is that Nifty, I feel now could consolidate between 23,100, 23,050 on the downside and 23,400, 23,430 on the upside. About 23,430, there could be a big move up to 23,700, 23,800. Now, this is the zone where most of the call writers are placed. So essentially, if this call writing zone is breached, then you will get a big short covering move on the upside. And that is what I expect in the next few days, markets to consolidate between this zone of 23,050 on the downside and 23,400. Coming to Bank Nifty now. Bank Nifty also, interestingly, has been consolidating closer to 49,700 zone. And however, last 5 days, last 4 to 5 days, it is still sustaining about 10, 20 days exponential moving average, which is now the important support zone. So closer to 49,200, 49,300 key support levels will be there for Bank Nifty. And once 49,900, 50,000 crosses, we could see a decent move up to 50,700 and 51,000 in the coming few sessions.
Mm-hmm. Okay. And in light of that, Sudeep, what are the stock recommendations for the morning?
Good morning, Niraj. The first stock that I like is GMR Airports Infra. Now, yesterday we have seen a good breakout on the upside. The stock has broken out of its consolidation zone of last 20-25 sessions. Right from 3rd May, the stock has been consolidating in this 80 and 88, 89 kind of band. And yesterday we have seen a good breakout back with volumes. Last 5 days we have seen the stock even on the candlesticks also it has been displaying higher top, higher bottom pattern. And daily, weekly, monthly, all the trends are quite strong. So I feel GMR Infra can be bought at current levels with 88 as a stop loss and 96 as a target on the upside. The second stock that I have is from the railways. Now, we last few days with the continuity in the railway ministry and the kind of growth trajectory that people have been expecting in the last several months, and now once again the same minister is taking charge. So that has acted as a positive sentiment for the railways. And overall, the sector, all the charts of this sector are constructively bullish. It's just that last few days we have seen some consolidation. And post that consolidation, we are once again witnessing an up move in most of these railway names. So the stock that I recall, yesterday we have seen the stock once again cross its short-term moving averages on the upside. The medium to long-term averages and the charts are quite bullish. But on the short term, also once again the stock has reversed. So I feel this can be bought with 263 stop loss and 285 to 290 target on the upside.
Okay, just before I go to Mayuresh, Sudeep, a quick 30-second answer. GMR Airports is in the F&O ban today. Could it face loss of momentum today?
No, I don't think so, Niraj. I guess the stock is quite good on charts, and this can be bought in cash. So all these levels that we are sharing are from cash levels only and from a cash basis only.
Got it. So the F&O ban may not deter GMR Airports, which is one of Sudeep's ideas. Mayuresh Joshi joins in with his thoughts as well. Mayuresh, great having you. Thanks for taking the time out. We are talking about some specific large businesses which are newsmakers today, starting off with Tata Motors and HCL Tech. What did you make of the Investors' Day outcome of Tata Motors? And did the comments that they've made, does it make it an interesting stock from a perspective of targets that they are setting out?
Morning, Niraj. No, so I think the transformation that Tata Motors has gone through, specifically the last few quarters, has been phenomenal. So the impairments that they had on their balance sheet and the repair that they've probably done has been astounding, to say the least. Now that the cycle has probably turned in their favor, specifically the domestic cycle at this juncture, the PV space expected to do well. Their EV portfolio and platforms, where they still have leadership position, and though competition might take some sheen off in terms of their leadership stake, they will still continue doing well in the PV space. You've already seen green shoots happening for the MHCV space as a whole, where a lot of analysts are pegging in decent recovery happening in the second half. So I think the domestic business is very well shielded. Now, when you come to the larger chunk of their revenue pie, which is JLR, the expectations of launches coming through on the EV side is something that will still hold up. I've been reading some mixed reports, Niraj, honestly, in terms of whether EV demand is holding up right now. There is some reports which are suggesting that EV demand is probably faltering. But as rate cuts start happening, you've already seen the first rate cut in the Eurozone. And as they start trickling through, both in the US context and the rest of the globe, ownership of cars is going to become easier. As more and more launches start happening, the cost of ownership of these cars are also going to go down. And therefore, I think the mix that they've probably got in terms of expectations of CNG and EV expected to go to 45%, I think that is going to remain healthy in the longer term. The stock might have run up a tad bit too much, but I think there is still enough juice in terms of what they can deliver, both on the JLR and the domestic front as well. So yeah, I think remain optimistic on this.
Okay, well, we take a quick detour and shift focus to what's happening at the center. Nirmala Sitharaman is all set to take charge of the office as the finance minister for the second time. My colleague Janani joins us from the North Block with more on this. Good morning, Janani.
Good morning, Agam. As you rightly said, I'm outside North Block, where Union Finance Minister Nirmala Sitharaman is all set to take charge in her second term as Finance Minister in the Modi 3.0 cabinet. Remember, Nirmala Sitharaman's been part of the Council of Ministers in all three terms of the BJP NDA government. Now, she started as MOS Finance and Commerce, quickly rising to Defence Minister, and now the Union Finance Minister. The upcoming July budget will be her 7th budget that she'll be presenting. Remember, she had presented her 6th interim budget on February 1st. So all eyes now on the July budget. In 2019, the July budget was presented on July 5th. In 2014, it was July 10th. So we're expecting a date sometime around then. But we'll know for sure when the 18th Lok Sabha session of the Parliament is announced. We're watching that particular session for two important details. One, when the budget will be presented now and what it will outline for the next 5 years of this coalition government. And the other, the Lok Sabha speaker seat. Now, whether MP Om Birla will continue to be the speaker is something that we'll have to watch out. And also remember, the deputy speaker spot has been vacant in the last Lok Sabha session. So we'll have to find out whether it will remain vacant this time around. Lastly, on priorities for the upcoming budget, of course, fiscal consolidation while maintaining aim on capex, but also looking at some of the concurrent topics that have come to rise, be it the MSME payment window issue, be it rate rationalization. Is there going to be the direct tax code that's going to come into fruition? Lots of questions that we're looking to be answered now in the July budget, but we'll have to wait as for now, and all we know today is that Finance Minister Nirmala Sitharaman will be taking charge at about 9:30 today. Back to you.
All right. Well, Janani, thank you so much for joining us and taking us through all that we can expect. Of course, we'll be continuing to give you more updates from the office of the Finance Minister. But on that note, we slip into a short break, and on the other side, we continue with all the market action. Stay tuned in.
Back with India Market Open right here on NDTV Profit. About 47 seconds left for the markets to kickstart trade. We are in, excuse me, 10 points lower maybe, so flattish start. We are in conversation with Sudeep and Mayuresh. Mayuresh, the other stock that stood out today for me from the large cap arena was HCL Tech. $278 million deal, but the point being that it is with an existing client and therefore maybe deepens the relationship. And a large deal allowed when discretionary spends are not quite active. Is it a leg up for the stock? Is it net positive, or you think it's at best a small pop, if at all?
I think it will be taken in its stride, Niraj, very frankly. And two aspects here, as you rightly pointed out. I think discretionary spending trends have still not come back to the fullest as we've probably seen. And the expectation is that the second half should probably see a lot of those positive trends start emerging in coincidence with the rate cut cycle and expectations of the economic outlook for specific sectors like retail manufacturing opening up. But what we've been hearing from reports in terms of BFSI, again, in terms of commercial real estate in the US, how that transpires in the next few weeks and the next couple of months is going to be extremely important in terms of the recovery of BFSI, which is one of the largest contributors to large cap IT stocks in general. So in my opinion, yes, I think it will be taken in its stride. Valuations are relatively cheaper compared to a lot of players within the mid-cap and the small-cap IT arena. And therefore, I think the stock is expected to do well. The commentary has been reasonably in terms of constant currency growth. Margins should be held out over the next few quarters in spite of wage hikes, which will happen in the next couple of quarters. But in spite of that, my own sense is that a recovery will come through in the second half. So yeah, within the large cap names, what we are doing at Markets with India is stocks like Infosys, HCL Tech are on our radar.
Right. Okay. Well, up and active. Let's see if it is. Don't quite know if it will be that way today, but watch out for HCL Tech. The first 1 minute rate is pointless per se, but could be active. Sudeep, if HCL Tech starts off slightly higher today, is it giving any trading hints, or would you avoid it?
Sorry. See, HCL Tech, if you see the charts, the stock had broken out of a consolidation zone right on Friday itself, but however, it was consolidating in the last 2-3 days. So I guess post this consolidation, if stock opens somewhere closer to 1460, 1470, I guess the pre-open is showing 1500 levels. But if it slightly opens, say 2.5% positive, then I guess there is still some trading play available there during the course of the day. So if it opens closer to 1470, 1465, then one could still go ahead and buy it with a 1420 as a stop loss. And on the upside, I feel levels of 1520, 1540, which was the earlier breakdown zone, could now once again be retested on the upside. And that is the 100-day moving average also. So that is the first level that I would be eyeing at, 1520, 1525 on the upside. So in line with where it opens, I guess that is important. 1460, 1470 should be a good entry point with a stop loss of 1425.
Okay, well, that's as far as HCL Tech is concerned. Mayuresh, we have a broking note this morning on the cement sector. And of course, it actually anticipates a price hike in several product ranges. Going forward, there is an expectation that the cement sector could potentially do well, but we also have the seasonality aspect when it comes to the monsoons going ahead. What's your assessment and anything that you like in this specific area?
Morning, Agam. So I think two things. One, in terms of the demand-supply dynamics, the expectations in terms of more supply, whether it's clinker or grinding units, are going to be limited to a certain extent over the next 12 months. And to that extent, demand is expected to grow exponentially compared to supply. So to that element itself, utilization levels expected to go higher for the sector as a whole. The second aspect, obviously, is as demand starts moving higher and there is recovery, input costs will also start moving a tad bit higher. So the pass-through of these costs is going to be extremely important, which should happen for most players. And the last aspect, again, in terms of government capex, specifically in terms of rural, urban housing and infrastructure, that is still expected to continue in an accelerated fashion, which means cement volume growth should be in double digits or 11-12%. in that range. Having put all these considerations into place, our take is that cement as a subsector for the infrastructure stroke manufacturing theme should continue doing well. Large names like Ultratech is something that we like at Marketsmith India. EPS, RS rating, institution holding, matches our cancel-in parameters. Valuations might be a tad bit on the higher side, but a nationwide presence, expectations in terms of solid growth is something that we look out for. Another two names, ACC and JK Cement, should also do well. A little bit soft in terms of JK Cement, but I think the recovery should honestly start kicking in over the next few years. So I think a few names that we have on our watch list.
And speaking of the cement sector, well, we have my colleague Harsh, who's joining us to give us a roundup of what the broking houses are making of it. Harsh.
Well, yes, Agam, such a strong focus with regard to infra over the last couple of days that can't help but not ignore cement, and a couple of very interesting notes coming through. You have Motilal, whose channel checks seem to indicate an 8 to 10 rupee hike per bag in terms of pricing of cement, which is likely a key positive given that April volumes for cement were muted. May volumes are expected to pick up a little bit. That's the other hope and expectation. 4 to 5% growth month over month expected in May as well. So some uptick in pricing, some uptick in volumes as well, which is a positive. Now, in terms of the domestic petcoke prices as well, Motilal seems to suggest that prices have declined 6% month on month, should further aid the cement industry. And this is a secular kind of a trend that's playing out as per Motilal. So it's across regions. That's the other key piece. Now, they're expecting demand momentum to improve even further from here, and their preferred picks being Ultratech within the large cap space, JK Cement and Dalmia Bharat within the mid cap space. Now, sticking with Ultratech, because Citi's top pick is also Ultratech, and Citi has also come out with a note on cement. They believe that Ultratech is their top pick in the space. They are expecting 146 MT of clinker backed incremental capacity to be added between FY23 and 27. They believe that ACC, Ambuja, Ultratech and Shree and Dalmia will account for 75% of this incremental supply. They believe that the trend of market share priority over pricing will continue, which has been the case. But slightly different from the Motilal view. They're expecting realizations in the range of -4 to +1 in Q1 FY25 versus Q4 FY24. So pricing is probably where there's a bit of a differential in terms of view. They're expecting the cement pricing trajectory to largely remain. So a couple of very interesting views on the cement space coming through.
Yes, indeed. Couple of very interesting things coming over. And if there's a price hike, wonder what moves there. Harsh, thanks so much for that. Firstly, a fundamental view, Mayuresh, would you buy a cement name?
Yeah, Niraj, I just mentioned, I think we've got Ultratech.
Okay, I missed it.
On our watch list. Yeah.
Okay. Sudeep, now my question is slightly different in that we've had 2 strong days of cement names before the pullback that we've seen in trade yesterday. But should the stocks open slightly higher, do any of them open up for a trade?
Niraj, I feel a couple of stocks are looking very good. So sorry. A couple of stocks are looking very good. Ambuja Cement now, last few days, if you see the chart, the structure, post that 1 day fall from on the election verdict day, post that the stock has once again climbed up, the higher top, higher bottom formations are there, and also the stock is now almost at the cusp of a bigger breakout on the upside. So I feel rather than an intraday trade, Ultratech Cement, Ambuja Cement, they both qualify from a positional trade perspective, and I see at least 6 to 8% price moves here in terms of charts in the next few sessions. So cement obviously is an overweight from our side, and in case of Ambuja Cement, if someone buys also at the opening here, the stop loss would be around 620. And from a trading standpoint, even for Ultratech Cement also, the stop loss would be closer to 10,650 on the downside.
Okay, so that's your entire, technical as well as fundamental view on the cement sector. Let's move on and talk about a handful of other counters as well. Among the banks, we're seeing a mixed cues coming in, and even in the private sector space, we're actually looking at some slackness when it comes to some of your relatively larger ones like HDFC Bank. On the other hand, while Axis Bank and ICICI Bank remain volatile, there has been a little bit of an outperformance there. Mayuresh, if you can actually come in on some of your, in fact, the top four large private sector banks. What's the way forward here?
I think the results have been quite decent, Agam, honestly. So if you leave aside HDFC Bank to a certain extent, where the results were quite reasonable enough as well. The only problem that the banking system faced, specifically the large private banks, was deposit mobilization. Now that should start smoothing out at some point of time in the second half. And as that coincides with the rate cut cycle at some point in the Indian context as well, I think deposit growth should start coming back. What they've really done in terms of their asset liability management has been stellar in the past few months. The RBI circulars in terms of unsecured lending, etc., have also helped to probably just taper down the aggressiveness shown in this aspect, and therefore the provisioning that is probably expected on this front also should shield their balance sheet. Advances growth, a lot of managements are speaking about decent loan growth taking place in the system, and the risk-weighted assets are adequately covered in terms of their PCRs at this juncture, along with asset qualities not probably going off the roof and remaining stable. So to that extent, BFS as a space is something that we continue liking from our sector rotationist aspect and expect it to do well. Axis within the large cap names remains on our watch list, but even a few select HDFCs, the larger ones, is something that we are probably looking at and remain a little bit more constructive.
Okay, 4 minutes left for the markets to kickstart trade. As we look at the pre-open session, two stocks stand out. One is Schneider Electric, and pull up the charts of that one. It's up about 5% in trade, if I'm not wrong, today.
Yeah.
And look at what Schneider has done maybe in the last 1 year. I think that's the telling piece, that Schneider has had a really good run in the last 1 year. So that's part one. Look at the 12-month trajectory for Schneider. It's quite crazy, really, as to what the stock has done, 244%. The other one, which is, the last 2 days has been on a roll, is ONGC. Up 5.5% yesterday, adds another 1.5% to itself in the session today. Sudeep, for somebody who's gone long on ONGC yesterday, is seeing this 1.5% uptick again today. Is it time to take money off the table, or would you stay long?
If you see the data also here in ONGC yesterday, last few days, we have seen some long positions being built here. And now the stock is in the vicinity of almost just 2.5% of its previous swing highs of the last 3-4 months. So I guess a breakout is around the corner, and this move is a strong one from the downside in the last few days. So I feel that the momentum is still there in the stock, and one could, if someone has bought yesterday or in the last few days, now key levels as a stop loss from a trading stop loss perspective, it would be around 272. So till the time ONGC sustains about 272, 273 levels, there are strong chances that the stock would make new highs around 286 and 290 in the coming few sessions.
Mm-hmm. Okay. Mayuresh, any thoughts on Schneider Electric?
Solid move. I don't know how the fundamentals are going to justify this. But yeah, solid move, and the sector is probably having a lot of tailwinds as well. So positive time at this time.
The thing about Schneider Electric is, of course, that over the past few weeks, it's actually dealt in circuits. So it's either a lower circuit of 5% or an upper circuit of 5%. And that's how things are going. And potentially today it's going to open at a 5% up move there. So that's the other thing that you need to keep an eye on. Very quickly, Sudeep, stocks on your radar today, anything that stands out for you in the last 15, 20 odd minutes after our discussion?
One stock which I feel we should be a bit, the focus has to be there is Prime Industries now. Just in the last 4 or 5 months, the stock was consolidating between 560 and 500. But last few days, we've seen a strong breakout there, and now the stock is on its way to create new record highs. So I feel Prime should be on the radar from a positional perspective.
Mm-hmm. Okay, and Sudeep, what's the top call for the day today? Is it still GMR? It's starting off higher in the pre-open session. Would you go out and buy that as a top call, or is it something else?
No, I like to stick with GMR because I see a good potential there, and I feel 96, 98 levels positionally in the next few sessions could be visible there.
Okay. Well, watch out for GMR. Sudeep sticking to it. It's starting off higher. Remember, it's an F&O ban, so you can't take a derivative position there. But Sudeep liking it. And he's also speaking about Praj Industries. After multiple days of consolidation, Praj is breaking out, so do watch out for that stock as well. Couple of names from his end. Remember, Asian markets are a bit mixed, so no great cues from that end of the market. The pre-open session, we're starting off about 1/3%, but we are wedged very, very nicely between the upper end and the lower end of the resistance and the support. 23,500 as a key resistance if the options data is to be believed, and 23,000 key support if the based on the put option data. So that's where we are on the Nifty. Let's see what components drive the index today, if they do. But here come the first rates on the on the market session today, and we're starting off about at the same levels, about 1/4%. Are slipping now a little bit. Banks flat. Wonder if IT is flat too. Midcap's about 0.4% higher, and the small cap index 0.4% higher as well. So in the green, breadth is looking okay. Maybe driven by Nifty IT. I wonder if HCL Tech has a part to play. Let's get the heat map up on the screen. Should be amongst the top gainers, HCL, if I'm not wrong. But a minor gain, 2%. But it's not just HCL, by the way. So HCL, Tech Mahindra, Wipro, LTI. You know, these tech stocks are taking turns. I'm playing those... The game, I'm forgetting the name, but you keep on changing. I think that's what they're doing, because Friday they were up and about, Monday they were down, today they are up again as a pack, so watch out for that. BPCL, couple of percentage points, Coal India too participating, but a lot of green, very little red, despite the fact that we are only 1/4% in the green. What's coming off? Again, banks. ICICI Bank still looking a bit wobbly. SBI, Axis Bank looking okay. Bit in the red. Reliance flattening out as well. So that's the long and short of it. Not too much in terms of stock movers per se on the large caps, except for IT, Agam, and 4 of the top 5 names in that pack along with BPCL.
Niraj, even the broader markets are moving largely in tandem with the benchmarks. If you just consider the way the mid-cap and the small caps indices are moving, there's a little bit of an outperformance, of course. As you can see, about 0.5%, advance for both the small cap and the mid-cap indices. But there's been a little bit of temperance coming through. We don't see that, your usual 1.5%, 3% uptick on either of these indices. But let's talk about some of these stocks which will be in focus today on the back of news. And of course, we have right at the top 2 companies where we have promoters selling stake. So the first one, of course, is Action Construction, but it is looking at an uptick. It's resumed there, but there you have it. War Wizard Innovations is where we are looking at a decline of around 9.5%. And remember that as Niraj earlier pointed out, certain considerations, and that's potentially what is playing on the minds of a lot of investors and traders as well. Of course, it is recovering. It's off days lows, but it is still down around 6.5%. So do keep an eye on that one. And let's move on and talk about the other stocks which are also in focus today. Now, in terms of orders and deal wins, both BL Kashyap as well as TVS Supply Chain doing well. BL Kashyap up around 3%, and TVS Supply Chain is also up around 6%. The tie-up with Daimler is what's working in favor of TVS Supply. And moving on, among other stocks which are also in the news, we have Dollar Industries. Of course, a positive update coming in, and the fact that they're maintaining a double-digit revenue growth, 11 to 12% revenue growth for the upcoming year as well, is a positive. NHPC again in the news, but it's marginally in the green right now, and Om Infra, Quant being the one to pick up stake in this particular company, is up as much as 11% as well. So all in all, more pros than cons, more pluses than minuses as far as broader markets are concerned, and that's something that's perhaps going to be a big takeaway here. And both the mid-cap and the small cap indices outperforming the benchmarks for now. Niraj.
Yep, well, watch out for some of these stocks, of course, and I'm just trying to see what else has moved. So yesterday, the likes of KCP had corrected quite strongly. Ramco had corrected. They're just finding some bit of balance. Let's see if this lasts or no. there is some balance in Suzlon as well. After correcting for a couple of days, that stock is finding some semblance of sanity. GMR Airports has cooled off a little bit, but still doing okay. That's one of the ideas along with Praj Industries, some Sudeep. So do watch out for that. And cement stays in focus. Mayuresh is constructive on select cement names. But let's just pull up that pack, Ultratech, ACC, etc. And those stocks too could well be in focus. Agam rightly pointed out Schneider Electric, so not quite dwelling on that. But TVS Supply Chain and Oracle. Remember, last thing, Oracle was up 9% in the global markets yesterday. And I think Oracle Financial Services is reaping the benefits of that move today. But Praj too, 4.5%, 5% higher now. That stock is certainly moving. Okay, let's take opening thoughts. I wanted to ask Mayuresh something, but Sudeep, I'm coming to you first. You pointed out Praj, 646, another 4.5% today. Is the zing away now, already digested, or can it do more? Would you buy it at these levels?
No, I guess now it's already up 4%. The stock is very close to its previous high of 650. So if someone's an extreme short-term trader and is playing just for trading for just for 3%, 4%, 5% gains, then one should wait to buy it on dips. But if someone is a positional trader come investor from a medium-term standpoint, then I guess this is a good breakout story. And there is something more than what meets the eye. So here, I guess there is some serious build-up of positions happening. A lot of volume breakout also has been visible here. So I guess this is a long story now for the next few months. We could see this stock continuing its trajectory on the upside. But yes, because of the overbought nature, the rally has been too steep, too sharp in the last few days. Wait for a pullback and then enter in that corrective pullback.
Okay, let's also look at the broader market, some of the big movers out there as well, and take a look at where and how things are faring. Among the bigger movers today, we have a continuation of the strength that we saw in HCC yesterday. HCC was up around 17-18% yesterday. It is up and about around 3% more, furthermore. So there's more buying coming through at the moment. And among relatively smaller names, you have something like a Premier Explosives, which has in fact exploded over the last 3 sessions. Today, once again, up another 2.5%, and we continue to see strength there as well. In the small cap space, there's another name like HPL Electric that's up around 3% as well. Again, continuing to advance. What's really standing out though in the mid-cap space is also Supreme Industries. I want to pull out just the last 7 to 10 trading odd days, and Supreme Industries has gone from strength to strength. It's up around, about 2% at the moment. But, it has in fact gone from the levels of around 5,300, 5,200, 5,400 all the way to where it is right now. And it continues to show strength. In fact, up as much as 19%. Even on the 4th of June, it didn't show as much volatility as much as several of the other names in the broader market space. And then, of course, you have continuing advances for something like an Apar Industries and Electro-Steel Casting, even in fact, you're beginning to see gains come back to something like an Amara Raja, though that's marginally in the green right now. But Amara Raja has also had a stupendous run. Actually, let's take this question with respect to the EV battery space forward. Mayuresh, if you do track what's happening with Exide and Amara Raja batteries, we've seen a very sharp surge in the last 3 odd weeks, and this is in anticipation that there could be a turnaround for the businesses of these battery makers going forward, and they're all betting on the EV space. There has been capital expenditure which has been earmarked for this as well from both these companies. What is your assessment on these two?
Also, I think they are taking steps in the right direction, Agam, as simple as that. So 6 gigawatt hours for both the players, Exide and Amara Raja, have been put in place, and they should be coming on stream over the next few quarters. Now, what really transpires is the first mover advantage that these guys have, and maybe the competitive intensity stays with a select few players like Exide and Amara Raja, because I think many players will have strong entry barriers to comprehend with. And therefore, the moats that both these businesses will carry in the EV ecosystem, and specifically in the lithium-ion battery space, is going to be stupendous. At the same time, with the expansions that they're probably doing, it is not creating a huge balance sheet stress. So I think balance sheets remain extremely healthy. And the kind of mix that they've probably got in servicing the auto players, the industrial players as well, and the replacement market, all these three segments are expected to continue doing well. So as OEMs start coming on stream, I think a large part of their business will and has evolved in terms of that play. With the existing battery system as well, I think as the transition happens, they will be servicing those OEMs and replacement markets as well. And the industrial component segment, when it comes to industrial stroke telecom, there is still significant amount of headroom available in terms of industrial batteries as well. So I think there is sufficient headroom in terms of earnings growth that can still drive strong entry barriers for their business, which will give both these players a very strong moat in terms of volume and earnings growth. And therefore that gets appropriately reflected in terms of a tad bit of a premium valuations that both these players command. So yeah, I think a lot of positive tailwinds for both these players, even in the near future.
Okay. Well, first 10 minutes done. Sudeep, what stands out? Is there a trade that you would initiate now after the first 10 minutes are behind us?
Niraj, one stock which is breaking out and where the news also was doing the rounds in the last couple of days regarding the housing space. NBCC is witnessing a breakout on the upside. The stock has now is now sustaining above its previous swing highs of the last month also. And we've seen a good volume action also here. So I guess NBCC can be kept on radar from a positional standpoint. 154, 153 levels would be a good support on the downside, and we expect levels of 172 to 175 levels, which are the prior highs. That could get retested and might even get more stronger if it sustains beyond that.
Okay. Well, so watch out, and by the way, watch out for TVS supply chain is up 7.5% now, so really shining. So do keep an eye out for that one in particular. On that Daimler order, up and about and kicking. So, yep, certainly a key stock to watch out for. The other one, Agam, is Sun TV. Yesterday was active. Today's up about 4% as well. Yeah. Something's happening there.
Yeah, certainly. And I reckon that this is potentially something to do with the political scenario as well, because ever since 4th of June, 5th of June, we're starting to see that little bit of a pickup as far as Sun TV is concerned. Again, not entirely sure if this is any sort of speculation. Over the past few days, there's been no reports which suggest a fundamental turnaround in Sun TV. Well, it's here for you to stay. I also want to pick up on some of your defense names, because there's been ever so slight uptick in names like BEL, Hindustan Aeronautics, Cochin Shipyard, Garden Reach Shipbuilders, Mazon Docks, what have you. And it's been a very, very quiet up move since the 4th of June. The question really is that can we look at these names going forward? Mayuresh, this question is for you. Sure, visibility of over the next 3 years, 5 years, but valuations even at this point in time do look a tad rich. Is that your assessment as well?
Largely, yes, Agam, and I think everybody's waiting for that large dip, which does not come. So I think any small fall in the stock prices are just getting gobbled up. And as you pointed out, I think the entire street is now aware of the various tailwinds. They've got humongous order books, which gives them revenue visibility over the next 4 to 5 years. They've been executing well. Look at the numbers that HAL posted in the quarter gone by. So I think even execution has been quite sharp for most companies within this space. The margins at which these orders are happening at a decent rate as well. And therefore, that entire operating leverage in terms of good execution and cash flows is getting reflected in numbers. Is valuation a tad bit expensive? Absolutely yes. Have stocks moved up a little bit too much for comfort? Absolutely yes. They're trading way above pivot levels as we see it, and in some cases even late stage basis, which makes it a case where if for any chance they miss execution in a quarter or two in the next few quarters, I think the markets might just start derating the stocks in that scenario. So I think execution risk is the only risk for these stocks. Any investors who are probably holding these stocks might continue holding on, but please manage your risk practices in terms of your exits as well.
Marish, Suzlon had this independent director resignation. The stock corrected for a day or two, has found its feet back. Any thoughts on wind power companies?
Positive, Niraj. And again, I think as Sridhar was saying, I think in your opening remarks that you played out, I think power as a space looks extremely lucrative. The kind of additions that we're going to do to wind, hydro, solar, and generally, I think the renewable target that has been set at 500 gigawatt by 2032, I think this entire ecosystem is expected to do well. Again, I think the interstate tariffs, which were a pain point for most power companies right from the period of 2018 to 23, I think many players have probably disappeared. Very few listed stocks like Suzlon, Inox will probably stay in the radar. With competitive bidding coming through, I think the tariff should show positive inclination in terms of top line growth. With more stability that they've probably achieved in terms of their operations, and therefore both on the EBITDA front as well as expectations in terms of a bottom line recovery, I think that should earnestly start playing out. So I think if you're really having a longer term view, I think renewables as a space within the power system should continue doing well. And that entire ecosystem in terms of power ancillaries, power OEMs, power O&M players should do well as well. So yeah, the space looks very, very interesting.
Okay. Mayuresh, Sudeep, take a moment to thank you for joining in today and giving us your thoughts, gentlemen. Really appreciate your time.
Thank you so much.
That's the view from our morning guests on what to do with some specific stocks. But, well, speaking of specifics, there is a robust T&D outlook and gradual margin recovery as guided by KEC International or spoken by KEC International, maybe to specific houses or otherwise. Vimal Kejriwal, Managing Director and CEO at KEC International, joins in to talk about the space and KEC's role within that. Mr. Kejriwal, great having you. Thanks so much for taking the time out, and I hope all is well. But it certainly seems like, Mr. Kejriwal, that all is well, because the outlook of the T&D pocket seems to be very, very constructive. Can you give us the broad brush about how do you think about FY25, but not just about FY25, for maybe the next 2 or 3 years?
Good morning, Niraj, and thanks for having me. I think I'm in this industry for the last 22 years, and I don't think we have seen such robust demand in the India T&D specifically. In fact, if you look at our order book, it has grown almost 3 times in 2 years, from almost, let's say, 3,000 crores to 10,000 crores from FY23 to today. And clearly, with the way the government is talking about how to meet the power demand and also the targets for renewable, at least for the next 3-4 years, we see this demand to continue in the same format.
Wow. Okay. The same format. Okay. So here, where is this? Where is this coming from? I would love to. I mean, we know that the space and the government targets for the overall power space are very, very tall. Do you reckon execution on the ground, Mr. Kejriwal, is happening at such a frantic pace to enable this kind of a demand? I mean, I saw numbers which said that your growth guidance of 40%. 40% on your base is not a small number.
So I don't know, 40% is what we have said is overall for the company we said 15%.
Okay.
Transmission around 55-60% of our numbers. We did say almost a 50% growth in the India T&D numbers. So India T&D grew 50% last year, FY24 over FY23. And we are saying that FY25 will again be another 50% over FY24. That's the India T&D piece. The second piece we talked about where this demand is coming. I think there are 2 areas.
Mr. Kejriwal, let me just come in because I would love clarity here. But FM Nirmala Sitharaman is just taking charge as FM, so need to cut to that for a moment. But this is the symbol of policy continuity. We've seen Nitin Gadkari take charge. Now FM Sitharaman take charge as well. Yesterday with Madhurav Scindia or Jyotiraditya Scindia taking charge as well. So I think in some sense, all of this is important. But Finance Ministry is as important as they come, and therefore FM Sitharaman taking charge yet again is a key symbol of policy continuity as well. So important. And of course, sound bites from her would be important. Sorry, Mr. Kejriwal, had to cut you. So let me just tell you what one of the notes is saying. I would love for your clarity from there. They say that it's a Nomura note which says that they expect KEC's management has retained its FY25 order inflow revenue growth guidance of 40% and 15%. So order inflow guidance of 40% and revenue growth guidance of 15%. Is this on target?
Yeah, I think the percentages can be slightly here and there, but last year we did 18,000 crores of order intake, and this year we are talking about 25,000. So I think that's what they are talking about, a 40% growth on the order intake. And revenue, yes, from close to 20,000, we are talking about achieving 23,000. So that's a 15% growth, yes.
Sir, I mean, are you being, are you looking to underpromise and overdeliver? The reason I ask you this is not just from the past track record, but also from the fact that if you're looking at a 7% real GDP growth, add inflation, so nominal GDP growth of 12%, the sector that you are in will probably grow much faster, and you being a leading company will probably grow even faster.
So, Niraj, as far as transmission is concerned, we are talking about higher growth numbers. But as I said, transmission is around 55-60% of our revenues. We have got civil, we have got railways, and there are other businesses. So I think that's where the growth is getting slightly moderated. That's why we're talking about overall 50. And I think last 2 years, we have seen issues happening on whether it's Red Sea, whether it's other issues. So I think we would be happy to be conservative and proven wrong later on. But I think that's where we are today.
Got it. Okay, this conversation, of course, has two important things. While Mr. Kejriwal is talking to us, FM Sitaraman take charge, and this is important. This is really important. Mr. Kejriwal, sorry for that interruptions, but this is as important as it gets, and really, let's wonder if FM Sitaraman does give a soundbite or two. It'll be important to hear from her about how she thinks about the next 5-year term as well, and of course, we'll watch out for that. So. And in some sense, I would love to understand from Mr. Kejriwal, while we are showing FM Sitaraman, of course, out here, but would love to hear from him. What does he make of this, this whole sign of policy continuity that we're seeing with FM Sitaraman is there? I'll just get to him in a moment, but this is as important as it gets. Actually, if she starts speaking, maybe we'll cut to her. But Mr. Kejriwal, while we stay with this footage, we'd just love to understand from Mr. Kejriwal what he thinks of this policy continuity. Mr. Kejriwal?
So I think we are pretty happy with, obviously, with the finance minister and also with the power minister, the railway ministry, with Mr. Vaishnav continuing in the railway ministry. Power ministry, obviously, we have seen a change with Mr. R.K. Singh going out and Mr. Manohar Khattar taking over. So I think that we will keep on watching. Railway, we do expect that despite continuity, I think we are hoping that there's a change in the priorities of the railways. Because till now, the last couple of years, we were seeing the priorities more on, running more trains and sort of rebuilding stations, etc. And a little bit less focus on the infra build. I do hope that now, this year onwards, we'll start seeing a lot more infra build happening in the railway sector, which would be tracks and signaling. Today, Vande Bharat is running at 70-80 kilometers instead of 140. So a lot of investment will have to be made, at the ground to ensure that we achieve the optimum, capacity, etc. So we do hope that at least on this part of railway, something happens. Power, I'm sure that there's no alternative. The way power demand is growing at 5-6%, and the government thrust continuing on renewables, there is need to expand the T&D network significantly. So I'm very sure that will continue.
Yeah, and I think that's an important point. While maybe one or two ministries have had some changes, but the larger focus very likely would probably continue. So I think that's the one thing to certainly watch out for. Okay, the optimism, the expectation that people have, Mr. Kejriwal, and maybe you guided to it as well. Because you've aimed for EBITDA margins of 7.5% in FY25 versus 6.1. That's a reasonably sharp jump on that base. What leads to this? And is that a new normal, or is it something that you pencil in for the year and the next year things might be different?
So Niraj, next year we have FY26, we are looking at a higher than 7.5. Okay, so we have talked about an exit EBITDA being close to 10% or double digit. That's the way we are looking at it. And if you look at the pre-COVID, we had touched 10.5. I think our margins went down in COVID because of certain specific events, which we can discuss. And last 6 quarters, we have been trying to improve the margin. So we touched a bottom of 4.6, and quarter on quarter, Q4, we were at 6.3. 6.1 was the average for the year. So we do expect that, we should be getting back closer to double digit in maybe by the end of this year or maybe next year or so. That's where our targets are. And I think the reason for the optimism is very clear. The margins went down because of specific events of very sharp increase in commodity prices and because of the delayed execution due to the COVID impact, especially in countries like Brazil, etc. And so all of them are behind us, which is why we are, sort of optimist and reasonably optimist, saying that we should be able to achieve a turnaround in our margins.
Mm-hmm. So in effect, when analysts point out that, for various reasons, how in the FY21 to 24 period, you gave margin guidance in all earnestness, but couldn't quite meet. So you're saying that those specific factors are behind, and any kind of volatility in metal prices or supply chain constraints will probably not be such a dampener that it doesn't allow you to reach 10%. I know there is a fear of an unknown always, Mr. Kejriwal, but I'm just trying to understand. You are reasonably confident that you will hit 10% odd in FY26.
So, Niraj, black swan event, as we said, can happen anytime. But the supply chain constraints are largely factored in our growth of 15%. If we are able to overcome, if the supply increases, transformers are available, GIS or conductors and all that are available, hopefully we can do better. So as of now, we have factored in whatever are the constraints in the market, especially on the supply chain. And that's how we have given this guidance.
I get the drift. Okay. Which from a bottom line perspective, growth is fabulous, Mr. Kejriwal, because if you consistently clock at this 15 odd percent, as you would, and if the margin picture improves significantly, that's quite strong. Okay, where are the risks, Mr. Kejriwal, to this? Because I heard you speak about how some proof of the pudding needs to come out on the railways again, because it's traversed away, but there is a lot more that needs to be done. So is it that you are confident about T&D, but the non-T&D areas are something that you would require to look at? Domestic versus international, what's your sense there? Could you take us through that landscape?
So if you look at the order book today, India is 75% and international is 25%, which is slightly different from normally it used to be 65-35 or maximum 70-30. It's 75-25, which itself is a proof of what is happening in the country. Especially obviously T&D, even civil we are doing very well. We have an order book of more than 10,000 crores. I think the only question mark in our entire portfolio right now is railways. But I think we are starting to see some changes. In fact, the orders which we announced earlier this week had almost 40% coming in from railways. So we do hope that railways can turn around, and that's one of the reasons why we are at 7.5%, not at 8 or 9, because of the lower margins what we are penciling in for the current orders which we have in railways. I think that's the only issue which I can see. Otherwise, I think on the metals and all that, we are, I'll say, more than adequately hedged and all that. So I don't see any major surprise or threat to our projections.
How big can the railways piece become, Mr. Kejriwal? And what about incremental orders in railways? I heard you say that the current orders have this margin of 7.5. Can incremental orders have slightly different margin structure? And how confident are you on railways becoming larger than what it is right now? Because frankly, when I talk to everybody in the markets, the two pockets that seem to have the highest growth potential, amongst others, seem to be power and seem to be railways.
So the current order book does not have 7.5% margin, but the new ones definitely have more than that. Okay. So that's why I was looking at saying that if we keep on getting new orders, start executing those orders, the margins will be higher. See, when you look at railways, what is happening is most of the growth what we are seeing is coming more from the rolling stock side and not from the infrastructure side. So you can look at any of my competitors on the railway business and you can read the commentaries of all of them, especially on the EPC part of it. I think that there has been some significant changes which have happened from the clientele being changed from the railway PSUs into the railway divisions, the contracts going away from BOQ to EPC. So then, the focus on running more trains. So that has led to a significant delay in giving block work so that, we can actually work and do the projects in time, etc. So I do hope that the government is very clear on these issues. We have had meetings with the railway board. They are also aware. And we do hope that all that will change. And that is why we are looking back at the railways. As far as the size is concerned, I don't remember, but I think we did around 35, 3,600 2 years back. Last year we did around 31. This year we are penciling a degrowth. But hopefully from next year onwards, we do expect the business to grow. If you ask me 3-4 years back, we are talking about railways going to 6,000 to 7,000 crores. Which let's wait and watch what the railway minister says, but that is always possible. The other piece in railways is that we have started doing international. We just started execution of our first order in Bangladesh. We have bid for some other countries also. So slowly a part of the railway revenues will start coming from the international as it does from T&D.
Okay. One final question, and if you follow Mr. Kejriwal on Twitter, viewers, you will see June 5th, they won a large civil order as well. And apparently, analysts believe that civil will propel order inflows. Could you talk a bit about that segment, Mr. Kejriwal, before we wrap up?
So civil has been a mixed bag. Overall, we are very happy with it. But if you look at industrial for me is still a laggard. Hopefully with the new government coming in, people will start firming and start investing. I'm talking about the private industry. Our biggest bet, which is paying off very well, has been on the residential side. I have never seen such boom happening on residential. And that order which you're talking about is the first order which we got in the NCR region. Otherwise, we were not there in NCR in the residential piece of it. So now we are doing very well. We are, I think, building around 65 or 70 towers today across the country. And a lot more inquiries. I think residential is doing very well. And on the back of it, we are seeing commercial real estate coming up. Okay, so those are two areas. And third, I'll say is data center. So these are the 3 or 4 areas which we are seeing a lot of push happening on the civil side. Hopefully with the new urban development minister and all that, maybe the metros may come back. But right now they are slightly on the back seat. But let's see how it happens. But overall, I think we grew civil by more than 30% last year. And again, this year we expect to grow it by more than 30%.
Got it. Mr. Kejriwal, we wish you all the best for achieving that margin guidance and probably eclipsing it as well. Thank you so much for coming in today and talking to us. Really appreciate your time.
Thank you for having me. Thank you. Bye.
That's KC International. Robust view from brokerages on what they are expected to do, especially on the PAT front. The stock is flattish right now, but the Nomura target is at 960. They've increased from 598 to 960 on very modest margin assumptions, by the way. Keep that in mind. Okay. More around politics. TDP Chief Chandrababu Naidu is set to be sworn in as the Chief Minister of Andhra Pradesh today for a 4th term. Prime Minister Narendra Modi, Home Minister Amit Shah, and BJP leader JP Nadda and several others are expected to attend the swearing-in ceremony. The TDP chief is scheduled to take oath at around 11 a.m. in Vijayawada. Short break on that note, but these are very interesting visuals. Short break on that note. On the other side, Focus Defense, Zen Tech's Chairman and Managing Director Ashok Atluri joins in. Stay tuned. Well, it's policy continuity. There is a lot of talk around the ministers taking oath today as well and what different ministries could come up. KEC International was talking about how commentary from railways would be important to watch. The commentary from defense would be important to watch as well because PM Modi spoke about it at the first instant after the election outcome that Atmanirbhar Bharat on defense remains a priority. Ashok Atluri, Chairman and Managing Director at Zen Technologies, joins in right now to talk about that and more, the impact of that and more. Mr. Atluri, great having you. Niraj here. Thanks for joining in. You must have been happy with how defense remained a key mention in the opening address of the Prime Minister after the election verdict was out. So do you expect status quo and maybe increased spends on the sector in a quest to make India Atmanirbhar in defense? Yeah, you are on mute, sir. Mr. Atluri, I think you are on mute.
I think what has been achieved in the last 10 years will be dwarfed by what will be achieved in the next 5 years. I think it's going to be a fantastic next 5 years. We are, with our grounds to the year, we know that Indian government is very, very focused on getting as much, not just manufacturing, but even the design and development, IP ownership, which is all about Atmanirbharta, to India and in India. And I think the next 5 years will be absolutely golden period for the defense industry and path to self-reliance in defense for the defense forces.
Okay, what would Zen, I mean, so one, I heard you mention it with your eyes and ears to the ground. Where is it that you believe the larger spends could come in? Because it's such a vast sector. Sometimes for a layman, it gets confusing. Could you talk a bit about how you think spending would happen in what areas within defense?
You know, again, because of my inclination, I'm a little biased, but I think the war is completely shifted towards drone-based attacks. You know, even Elon Musk has said the warfare is going to be drones versus drones, not human beings versus human beings. So I think the counter-drone system and the whole of drone ecosystem is going to get a very big boost in the next 5 years. And the second is the amount of combat readiness. You know, you may be having Iron Dome and all that, but people are coming in with hand gliders and taking over the country. That means something, the preparedness, lack of preparedness, something. Even when we look at Ukraine, it has world's most advanced equipment gifted, but it's not able to operate it. And, with vintage equipment, Russia is able to really, really inflict tremendous damage on Ukraine. So training is going to become the second most important thing after the drone ecosystem development. I think these are the two areas where people will be really, really focusing on, Niraj.
Okay. For your state as well, Mr. Atluri, I mean, as in what I mean to say is, if I'm not wrong, you are from Hyderabad? Yeah, am I correct?
Hyderabad, Telangana, yeah.
Yeah, Hyderabad, Telangana. Okay, so in some sense, does Chandrababu Naidu coming back have a material impact on how development in that area could happen, and do you potentially benefit out of that as well in any fashion?
Yeah, actually, Mr. Naidu has been a fountainhead of all this culture of technology for. Even though he is not part of Telangana, but I think almost a corridor will come up, and companies that are focused on especially coastal defense, like Visakhapatnam is a big center for that. So we do think that there will be some synergies where with Mr. Naidu coming in, and he's very, very pro-industry. So we think a lot of defense work will probably start in Andhra too. So in naval-related fields, so that is one area we really want to collaborate with the Andhra Pradesh government.
Okay. Now, I would love to understand how would this work out in terms of numbers, Mr. Atluri. I remember back in October when we first spoke, when you had come out with your Q2 numbers, when your revenues went up 100%, you mentioned about how looking at the order book execution back then, when your order book was about 1,400 odd crores or 1,487 crores, if I'm precise, you had spoken about how you would do X in FY24 and double what you do in FY24 and FY25, and then the show will go on. Now, it's been 6-7 months or 8 months since we then spoke. How has the picture changed now, if it has?
So, at that point in time, I said that we'll do at least 450 crores, Niraj, but we fell short by about 20 crores. We achieved 430 crores. And we said the next year we'll do about 900 crores. So this 20 crores has, definitely pushed into the next year. So, my thinking is that we should at least do 920 crores. if not much better than that. So 920 crores is what we have been expecting to do this year. And after that, we are saying that, conservatively, we should grow at a 50% CAGR. And, while people not in the field express surprise, that's a very aggressive target. Those in the know say, Ashok, you are setting a bar too low to jump easily.
Okay, interesting. The other thing that you had told me, Mr. Atluri, is on the kind of order wins that you get, because you had mentioned that how at times there is very low competition because of the IPs that you own, and the government wants such companies to come out and bid, and therefore in some of the order wins there is hardly any competition for you except for BEL, maybe, if I can remember it correctly. So tell us if that landscape is changing, and does that have an impact on your margins, or you reckon about 30% EBITDA margins is something that you'll be able to do even on a higher base?
So I think the margins will continue to be what have been in the past. And I think it may be more than 30%. And, again, if there are some companies that are willing to spend the money which is required for the R&D and compete with us, that will be a very, very healthy thing to do. But we, as a company, as an industry, defense industry has been always relying on external funding, whether it's DRDO or the government or IDEX. There are very, very few companies, it's very, very, very difficult for me to recall any other name, like Zen, that are doing self-funding of R&D and investing tens and maybe hundreds of crores till now to build products which they are not sure whether the government will buy or not, or importance is there. Even though we do a lot of research, talk to the army and find out their need, and based on that we develop it. There is some of the products are not being sold till now. So that risk taking is still not there, is what I feel. But when that risk taking companies do come, we do expect some competition to emerge. But as of now, competition has been scarce, between few and scarce.
Okay. And my final question, Mr. Atluri, you mentioned about how your inclination is towards drones, but I would love to understand that while that may be an inclination, what else or where else do you reckon high growth could come in? Because earlier I remember that you were shying away from setting up manufacturing, then you took up something in Goa because it was coming your way due to some arrangement, etc. How do you look at that picture? Make yourself versus outsource, and what areas do you operate in aside of drones?
Counter drone space is going to explode. We are talking to all the our customers. The requirement is going to explode, and they want a lot of customization to be done, which only an indigenously R&D prepped company can do. So we are working with them and doing the R&D and creating a counter drone system, which will not only be available to India, but whichever Indian government is, says supply to those countries, we will definitely supply to friendly countries too. So for this, the manufacturing facility that, as of now, the manufacturing setup is mostly outsourced, but we are looking for the Goa facility, and, we are looking some new kind of product, but not much on the counter drone system, but it will be a new product line that may go there, but which is under negotiation. And, I have earlier said there will be some new product announcements as we go ahead. And once those come, we will probably be able to see the Goa use towards, the new technologies that we are envisaging.
Got it. Great. Mr. Atluri, we wish you all the best in these endeavors and more. Thank you so much for joining us and giving us some perspective on this very important day. Much appreciate your time.
Thank you so much.
That's the view from Zen Tech. And with that, it's a wrap on this leg of India Markets Open, on the note that the Nifty is pleasantly poised or pleasantly perched over 0.5% higher today. It's been a bit of a trending morning where we started off low and then have expanded through the day. So it's actually turning out to be a really good day. Sorry, I'll take a minute more actually. Need to pull up the market breadth as well and just show what the market breadth is looking like, because the markets are really doing well and the large caps doing so well. Look at that. That's nearly 1:5 in favor of the advances. Splendid showing this morning. Let's see if this continues for a better part of the day. Thanks so much for tuning into India Market Open. Up next is Talking Point. Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Vinay Jaising, MD and Co-Head of Portfolio Management Services at JM Financial. Vinay, great having you as always. Thanks for taking the time out. Hope all is well.
Thank you so much for the opportunity.
The pleasure is ours, Vinay. And Vinay, are the markets giving an opportunity to buy or to, as they say, just go a bit light on your portfolios because of the valuations?
So if we had this question 4-5 days ago, the market did give the opportunity, when people were concerned when the market, Nifty was going almost 10% down midday. But all that is recovered. Now, to me, it looks, do what you were doing earlier. It's business as usual. The cabinet seats are more or less, framed out to where they were earlier. You're waiting for the budget, which is the next big event a month from today. So if earlier you thought stocks were frothy in some spaces, you should change that. If you were earlier sticking to your theme of, let's say, consumption, capex, make in India, you should think to it. So you got to go now back to basics. Election is behind you. The fact is, you expected probably election going, one-sided, which is not. And, coalitions have their own set of advantages. But you still have a single standing government, which in the last 20 years would be, the third or fourth largest single standing government party votes. So I think you're just back to business, and whatever you were doing earlier, you got to stick to doing that as well.
Okay, as we speak, we are on all-time highs. At all-time highs for the indices, the Nifty's hit a fresh high, and it's looking like a robust market today. So if there were any concerns, and I'm a bit surprised really, because I really thought at the start of the week that ahead of the FOMC commentary coming in, very unlikely that we'll take a clear directional move. For now, if this is how the day is going to shape up, then there is a bit of a directional move that the market is giving after a couple of days of consolidation post Friday's heroics. But very strong moves there. Most stocks and most sectors in the green, but look at the trend and look at the top winners. And it's all PSUs, actually to an extent IT, but PSUs are right up there. Also wedged in there is Tata Motors, of course, after their investor day, but just classic really what's happening in the markets. Very strong momentum and fairly strong buying in the large caps, but I must say mid caps are not too far behind, because while the Nifty is at record highs, the market breadth is terrific. It started off strong, it stayed strong for a better part of the day today thus far for the first 1 hour, and let's see if that were to continue. Let's talk about what do you do. I'm going to dwell a bit upon themes today, and then we'll end the conversation with the FOMC piece maybe. So we'll kind of do the reverse than what we normally do. PSUs, there was a scare that if it is not a majority, if it's a coalition government or what have you, then does the PSU theme, which has worked beautifully in the last 12 to 24 to 36 months, does it go out of the window? I would love to understand how you think about it.
So I would say, as you rightly said, 2 to 3 years ago, the discounting which PSUs had compared to the private was huge. That discounting is now narrowing down. The productivity which PSUs were working with were much lower than the private, and that productivity, debatably, is pretty much as where the private is. Then it comes to opportunities which PSU have against the private. And, case in point, let's say defense. In defense, the PSUs have a lot more capacity. They're getting a lot more orders. I guess, the Indian government is giving Indian owned companies more orders, and they've become monopolistic leaders. So you can't make a generic comment on PSUs now going ahead that as a basket would do well. But what you can say is, if you can see the balance sheet and being high quality, which means no debt, good cash, if you can see an order book, which PSUs have, that's in manufacturing or in defense, then you're there. Valuations a lot more as far as PSUs are concerned. For banks, relatively still cheaper than the private, but even the private have got derated a lot. But apart from that basket, I cannot make a generic comment now that PSUs are going to be doing as well as they've done in the last 2 years. It's all now about bottom up, picking the stocks in the PSU you like.
Okay. So then okay, let's try and focus on maybe some of the privates, right? And start off with banking. Now, and there is a larger implication to the banking conversation, because in all probability, banking will do well when the foreign flow starts coming in. I would love to understand, Vinay, from you, how do you think about that piece? When will foreign money start coming back? I think it was Rhythm yesterday was making this point that if FIIs have to move away from their underweight India stance to even a marginal overweight, that leads to an inflow, or that necessitates an inflow of $40 to $50 billion, which is not chop change. Love to understand when you think FIs will come back to Indian markets.
So, I totally agree with this comment. Today, if you look at the ownership of FIIs, we haven't got the data of this quarter. Last quarter was 16.6, but we know they've already sold $4 billion in the last 1.5 months, which means FIIs have to be lower than 16% as a percentage of the overall ownership in India, and that's more than 10-year low. The average number, if I were to take 18, or if I would go to the peak level of 20, because, mind you, this is the government which has come into power for the third time, and this has happened after 1962. So, now's the time for the government to take its power and use it for whatever reforms it's produced in the past. So, FIIs should see seemingly constant policy actions, and profit of India should go up. A 4% increase in FII mathematically on a $5 trillion market cap is $200 billion. So I'm assuming $200 billion divided by 4, even if they have to do it in 4 years, is $50 billion on a yearly basis, as against $25 billion last year. So it's waiting. When will it come? My bet is, come budget, and you'll start seeing the same story that, CapEx numbers are great. Rural spend, which was not there earlier, maybe a little bit of a populistic bias there, would increase. But luckily, because of RBI, there's about 1.3 trillion rupees, which the Indian government can use and still stick to prudence in fiscal policy. Even oil relatively is cheaper than higher. So subsidies, are not a big picture. So as long as the budget comes where you see the fiscal prudence, you see the capex and the rural investments come in, I think FIIs will start coming in soon. Having said that, interestingly, if I were to turn your question on the other side, that why is the market high today compared to what it was, let's say, during the day the election results came out, it's been the other segment of the market. India's not just bank formation, if I may use that word, or, the pension funds, the EPFO, the retail money, whether it's from UUHNIs or, the rest of the Indians, that has been a strong $12 billion. I repeat, $12 billion in the last 2 months. So if you're getting flows from domestic so far, FIIs are down. As soon as they start coming in, can you imagine the liquidity the country would have? One last comment, sorry I'm long. We have spoken earlier about, India included in debt for emerging market indices. You've already seen $15 billion of debt coming in the country in the last 12 months. Another 10 odd is expected to come in to make that number of $25 billion. So now you're seeing India flushed with inflows of Forex coming into the country, which is why our Forex levels are very high.
No, I mean, don't mind the long answers, Vinay. We love to listen to you, so completely fine. I was looking at the portfolios as well, and you have this very interesting terminology, finsumption. Talk to us about this.
So, India's per capita GDP, give or take, changes 2,200 to 2,500. When you go from that level to about 5,000, you start spending a lot more in consumption items, not just, what you need for a day-to-day living, but, you start increasing your housing, you start increasing your quality of living, you improve your quality of living. So, that's the consumption angle, which comes into the picture. The second part of it is financials. Today, the banking sector loan book growth is, give or take change. I'm removing the HDFC impact of not being there last year and, Mammoth coming in this year. Between 17 to 18% is what our analyst Pooja tells us on a yearly basis. If that number even goes down to 15 to 16%, you're seeing a very robust banking system. The overall banking system price to book is low. So you will see FIIs, look at that space. My only concern in the banking system is you're seeing interest rates peak and come down. When interest rates come down, your loan book growth would be better. But that does not mean that the NIMs may not be impacted and you may see a squeeze in NIMs. And classically, when you're seeing squeeze in NIMs, even if the top line's growth, most of these companies are so efficient that they don't have much to cut on the cost part of it, that your bottom line growth, unlike the last 3 to 4 years, is not going to be north of 35%. It's actually going to be exactly like your loan book growth, which is 15 to 17%. So you're looking at the financial sector, especially banking, coming in and a growth phase of 13 to 17%, not higher than that. And that's what investors have to realize, but the valuations are very attractive. So, financials come with the consumption part of it. The consumption comes with the, as I said, the per capita GDP of the country going in. And then there are some companies in between, companies which are exchanges where retail India starts playing the financial market, and you've seen where the options market is. Because of which you start seeing the earnings growth of companies, let's say companies like BSE, grow from an EPS of, north of 20 to as much as probably 100 in the next 2 to 3 years. So you're looking at growth as much as, north of 50% per annum coming in a couple of companies, which is what investors want to see. They want to buy a country where the growth in the earnings is really good.
Yeah, most certainly. It's interesting when people compare mature developed assets to what's happening in India per se, and then talk about relative valuations. Sometimes they're right, sometimes they're wrong. Vinay, that one argument before we take a break, wherein a lot of people, like today there was a comparison, I'm just using that as an example, you may or may not have thoughts on that, but there was a comparison being made about how GMR Airports Infra trades at about 50 times EV EBITDA FY24. And FY26 maybe about 25 times, that's okay. Whereas ADP, which is an owner of 32% shareholder in there, but in the global assets, they traded about 10, 15, 20 times EV EBITDA. And how GMR might actually be expensive as per a global note from a global brokerage. Just trying to think, are these comparisons legitimate, Vinay?
It's a very interesting philosophical question. I think everything's legitimate because at the end of the day, you want to make money, whether you're an Indian or whether you're putting your investments from abroad. What we as a team do is we look at valuations not just domestically, we compare them to the peers. If there is an earnings growth trajectory which is few times higher than that of their peers and the ROAS also is similar, then we would look at that company a lot more logical. I won't talk about GMR. But what I would tell you is take an example, let's say of, I'm just moving the stock into the other discussion you had on consumption. If you look at a consumption name, let's say something like a bottling plant like Varun, people globally would say this is a bottling plant. Now in India, when you look at a company and look at its earnings growth coming, top line 15 to 20%, bottom line historically grown at 30%. What you're going to say is, wow, this has definitely got a tie up with, let's say, Pepsi for the next 20 to 30 years. So though it's a bottling plant, it's actually owning the brand for a long period of time and they're partnering themselves for the future, right? When you move to the next step, then you say that the earnings growth and their ROAS are way better than that of the rest of the world. You're talking about a ROAS of, let's say, 20+%. You're talking about an earnings growth of, even today, after going up to such high levels in the EPS of 20+%, and they're an acquisition spree. So you would give a lot of other parameters, which is growth, return on capital employed, quality of balance sheet, before you come up with the conclusion that you want to buy the stock in India, if it on an absolute basis is expensive compared to the world. You mentioned obviously a company whose part ownership is global. So there will always be a holding company discount because the parent may never sell it. And if the parent doesn't sell it, let's take the case of, let's say, Grasim, will you put a discount of 30% or 50%? So once you put that number, the valuations may not be significantly different in the overall scheme of things.
Okay, Vinay, stay on. So much more to talk about. We need to slip into a very quick break. On the other side of the break, we try and talk about some of the local factors, but also an eye on the big event of the day today, which is the FOMC, and what implications could that have for Indian markets. It's a very important part of the markets. You don't want to miss this. Stay tuned. We'll be right back. By the way, all-time highs for the markets as we spoke about, clutch of names. And remember, the market breadth has doing very well, which is the key thing. And a clutch of individual stocks have, as they always would, are doing well. But some of the MNC stocks are certainly rising in the session today. So that's a bucket that you want to keep an eye out in trade. Schneider Electric notwithstanding, there's a few others which have done well. So that's part one. Yesterday the MNC index was doing very well for itself. So that is to be kept in mind. ABB is up about a couple of percentage points in the session today as well. So that's some stocks that you should keep an eye out for. Aside of that, we've seen newsmakers like Elecon Engineering, like Trident and a few others doing well, and media seems to be a bucket which is doing okay. But if you look at the BSE 500, the top 15 names are very different than what you get in the recent, what you've gotten in the recent past. From an MMTCA to a Tata Tele to a Tanla Platforms to the Network 18 TV 18 Twins to a Sun TV or to a TVS supply chain, the list of gainers is materially different. We are in conversation with Vinay Jaising, MD and co-head of Portfolio Management Services at JM Financial. Vinay, when I look at how you are building out the portfolio, if you will, so we spoke about finsumption as being one of the things. I would love to understand the Make in India angle, because some people would attribute the capex cycle also to that. When you're talking about Make in India, what is your favorite, or what are the first amongst the equals?
So I would say two sectors, right? Make in India is taking care of two things. One is where globally India needs to supply products to, where it can be a replacement of China or other parts of the world, for which the manufacturing angle of India needs to be intact. And the second, more easily, is where India was doing a lot more imports and where it can replace it. On the first, you've got a couple of chemical names, you've got a couple of pharmaceutical names which tie that basket, you've got some auto names. And in the second part of the story, you have companies like defense which are replacing global trades, the Atmanirbhar part of what Modi ji has been pushing for the last decade, wherein you're buying a lot more domestically than the rest of the world. So both legs, capex very important leg of it, because capex is where they're telling the Indian operators or manufacturers, we're going to buy more from you. The PLI angle, we are giving you a lot more benefits or SOPs, which they didn't give, let's say, till at least 15 to 20 years ago. They're just coming back now, giving them some benefits on the revenue share part of it. So, even the tax angle coming down from 25 to 15 for manufacturing gets this Make in India theme, either for getting the dollars for the country and supplying products which the rest of the world needs as a replacement for China, but more importantly, just not buying enough from the rest of the world and depending a lot more on the country. So both things are very important, and capex and manufacturing are an integral part of Make in India.
Okay. Your portfolio presence seems to be around chemicals as well. It's a sector that has kind of labored along in the last 2-3 years after a fantastic previous decade. Does it make a comeback immediately, or are you still data dependent?
Extreme data dependent. So, the word chemical, I was using it a little more loosely. When we're talking about chemicals, we are adding a bit of agro, we're adding a bit of pharmaceutical, and a bit of specialty chemicals. The specialty chemicals is going to take a lot more time, I think, to catch up, because that's where you're depending on China. China is showing some PMI data, some of their manufacturing data doing better. So that's the last leg. That's the bet you're taking on a longer period of time. But the other two legs, be it, the pharmaceutical chain or be it the agro chain, that's where we think the story will emanate a lot more closer, which is in the next 3 to 6 months. That's where we would bet on a lot more today.
Okay.
We're again not changing positions significantly. We had already taken positions in them, and we're pretty happy that that this is the time we think the next 6 months they will do a lot more better than the past.
Noted. When I have one final question, can the Fed append the moves in the market by its commentary, or would you reckon it's more of status quo and watch data again?
So I'm going to break this question into two. Can the Fed do it? Yes, they have to do it because you've seen what's happened in Europe. Will they do it now? Or will they say that in the next quarter they're doing it and they would do it, as against, if you remember, we used to earlier talk about 7 to 8 cuts. They would do it as against, let's say, 1 to 2 cuts coming in the next 3 months to 6 months. I think that's a huge possibility. Why would they need to do it? Because, at the end of the day, if you look at the debt numbers of US, $34 trillion, that is a duration of somewhere close to, I think, about 6.5 years. So you're seeing about $7 trillion of debt keep on coming by for renewal. Now that $7 trillion of debt comes and you're replacing it at a higher rate of interest, as against, you cut it a couple of quarters later at a lower rate of interest. It's a circle. You're getting your own fiscal deficit higher if you were US. So they need to solve that. You've seen the pain points come up, in the credit card data, which US is giving you. You've seen the pain point come up in the mortgage data. The 2-year, 10-year chart is still negative 40 basis points with 10-year being lower. So that itself is telling you there is pain evident and they need to cut rates sooner than later. But I think because they're getting strong data points on some manufacturing part of it, they've been yo-yoing as delaying it. But it's inevitable. So you will get that news where the number of cuts will be lesser. My bet is in the next 3 months, they'll do the first cut, not today. Today, it'll be more news driven. But the second part of it, my friend, is a function of what happens to India. Because India is still, if you look at the 10-year or the 2-year chart, give or take change, if I'm not being cute, it's just 7%. It's not higher, not lower. And you're seeing so much of inflows come in the country. A big question is, are we going to decouple the interest rate fall of India with that of US? Because, if I just do, just take the two broad numbers, 7 minus 5 or 4.9, we're at 2.1, 2.2%. Between India and US on the longer term, that's too small, too less, as against, let's say, 4%. So I think that decoupling is getting for India being a lot more real as we start attracting, and back to your first question, more inflows, be it from FIIs or FPI.
Interesting. Vinay, thanks for breaking it down, really. Good of you to do that. And more importantly, thanks for joining us today for this long conversation. Really appreciate your time. Look forward to having more often.
Appreciate it. Thank you, team.
And viewers, thanks for tuning into this edition of The Talking Point.
Fresh record high for the Nifty, crossing 23,400 barrier for the first time, while Sensex trades above 76,900. All sectors in the green, barring FMCG. Financials and media lead the gains. Nirmala Sitharaman takes charge as the finance minister for the second term. The budget expectations start clock ticking. TDP chief Chandrababu Naidu is set to be sworn in as the chief minister of Andhra Pradesh today for a fourth term. Prime Minister Narendra Modi, Amit Shah and several other leaders expected to attend the ceremony. Big news coming in for the auto space. Ola Electric receives SEBI's nod for 7,200 crore IPO. Will become first automaker to list in India since Maruti Udyog in 2003. Hello and welcome. This is the F&O show. I'm Agam, Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equity markets. Well, at the moment we are seeing advances for the Nifty making a new life high, and it has hit the 23,400 mark. Just shy of that at the moment, up 0.6%. The Bank Nifty has shown a lot of strength as well. It's up around 0.9%. And the outperformance here is well for everyone to see, because we are looking at a good 400-point up move. And it was a swift move earlier on in the session. Within just 15 minutes, it climbed as much as 250, 300 odd points. And well, I reckon that it's also moved above the mark of 50,150 to be precise is where it's currently trading at. Well, let's move on and talk about the constituents of the Nifty and see where there is a pull and push there at the moment and how things are faring. So we do have HDFC Bank, Reliance and ICICI Bank advancing, providing a bulk of your gains. What's weighing down in the season, not by as much, is HUL, ITC, M&M, as well as something like an Asian Paints. Well, moving on, in terms of how things are faring as far as your broader markets are concerned, again, an outperformance clearly, pardon me, for the mid-cap and the small-cap index. And, even in terms of how you expect the futures and options space, let's pull that up as well, and to see whether or not there has, in fact, been some traction there. No, not really. So open interest is just around up around 1.6% as far as the Nifty futures are concerned. And when it comes to the Bank Nifty open interest, that's where we are looking at a significant 6% increase in OI there. Let's move on and talk about the options market then. And in the options market, of course, things would have changed potentially. Remember that we were looking at a significant amount of writing around the 23,500 call, but it seems like there's been a little bit of unwinding there, and now there seems to be a lot more writing of puts on the lower end. So that's the other interesting bit out there as to how things are faring at the moment. Well, that's as far as your benchmark indices are concerned. Let's get in our experts for today. We have Brijesh L of IDBI Cap and Akshay P. Bhagwat of GM Financial, who's joining us on the show. Good morning to both of you. Thanks for joining in. Akshay, let me come to you on the Nifty at the moment, now making a new high today. Well, what's the way forward?
Good morning, Agam. So positive trades for Nifty. It's the last couple of days have been pretty quiet for the Nifty index. And my belief is, considering the huge degree of volatility of daily trading of over 1,000 points, which we noted last week on an event-filled week, Nifty is taking a momentum break, as I understand, in the past couple of days. Slowly, the momentum is trying to regain 23,000. Somewhere is the base where the put writers in the futures and options space are shifting their writing bets to. Your volatility index has cooled off significantly below 15 mark. So normalcy is back in the system. So Nifty, the way forward is that 23,400 is a minor intraday resistance. resistance, because last couple of days you had some sort of resistance at these levels. There is a Fed event tomorrow, so the market slightly is on the back foot, but overall the setup is extremely positive. 23,550 and 23,700 are the two positional targets I'm looking forward in the next 5 to 7 trading sessions. So stay long in Nifty till 23,000 holds. That's the broader support for the June, which is playing out, and 23,700 is the target I'm working with for the Nifty index.
Okay, that's your view on the Nifty. Brijesh, good morning to you as well. What about you? How are you viewing things on the Nifty right now?
Hi, morning. So definitely my view is also positive. I believe this the level of 23,500, which as you rightly said, the call writers are unwinding their positions. So I believe this level will be taken out during the week, and I expect the weekly close to be about 23,500. On the way down, 23,300, 23,200 are the immediate supports. And directionally, the 50-day moving average comes somewhere close to 22,500. So my sense is that until unless we don't break 22,500, directionally, we are not going to change any view. It could be more of a range-bound kind of a trade. But having said this, I believe 23,500 will be taken out by tomorrow's session. So bias will be positive. Bank Nifty is also has paid up above 50,000 level. So I think that call writers who were active has now unwinded their short positions. So both the Nifty and Bank Nifty, I believe it should trade with positive bias.
All right, that's as far as the Nifty is concerned. Brijesh, coming back to you, your reading on the Bank Nifty at the moment, which seems to be stronger than the Nifty right now.
Yeah, definitely. I think there has been shift in the range in the Bank Nifty. I would likely to bet for 51,000 as a next level in the next 3-4 trading session. That can be a quick move in the Bank Nifty as well. Today being expiry, Bank Nifty expiry, I don't think now it may slide below 50,000 mark. So I think Bank Nifty, the trade, like the strike price of 50,100, which is trading at 180 strike price. I'm of the opinion that we can take a long bet in this trade at 50,100 strike price call option. So I believe levels can be tested in this particular strike price today itself. So bias extremely positive, and directionally also, as I said, 51,000 is what I'm looking for the Bank Nifty.
All right, 51,000 on the cards potentially. Akshay, what about you?
Yes, so today being the weekly expiry, what we are noting right now is 50,000 has a strong presence of call writers for today's expiry for Bank Nifty. Slowly the writers are seeing shedding action. It's not complete as of now. Still there are a lot of large concentration of call writing bets. They are taken on the wrong foot with the opening which we saw in the first hour of trade in Bank Nifty. So I would be keen on as to see how 50,200 trades for intraday. If 50,200 is taken off for bank index basis spot, you can see a strong momentum rally in the day trading itself, where 50,500 can be the upside target. As of now, I see 49,800 put writers are getting pretty active. So one thing is clear, that 49,800 is the base for today's weekly expiry and for the short term for Bank Nifty. The view is definitely positive, but as an intraday or an expiry trader, 50,200 is the level which you should keenly follow. If that takes off, expect strong momentum to regain in the bank index for day trading.
Akshay, at the very moment, do you think that the risk-reward ratio is favorable if one were to initiate and buy the 50,200 calls?
Yes, absolutely. It's worth taking the risk. In fact, if 50,200 would be at the money, I would be more comfortable even if you go for a slightly deep OTM call, maybe 5,400 or 5,500, if your trade is limited for the next couple of hours. Because once 50,200 is taken off, the momentum will strongly pick up. 150, 200 points might just happen in the next 2 to 3 hours. And if that happens, even deep OTM calls will see the premiums flaring up. So yes, 5,200 is the right choice of strike if you are okay with the premiums on the expiry day. If you want to take a hero or zero kind of bet, then for the next 2 to 3 hours, 50,400 is what I would recommend once 50,200 basis spot is taken off in the bank index.
Fair enough. All right. Well, on that note, let's shift focus to all the stocks which are buzzing in trade today. And we take a look at how things are faring as far as stocks go. So we have longs in Sun TV. Another up move around 4.5%. Oracle Financial Services picks up steam yet again. We have Interglobe Aviation, which is under a tad bit of pressure, building on the kind of losses that we saw yesterday. ICICI Bank is up 1%, but it has a 5% increase in OI there, along with IndusInd Bank as well. So longs there too. Among stocks which are seeing unwinding, we have short covering for EBB, Bharat Electronics, Hindustan Copper, as well as something like a Balrampur Chini. Longs unwinding for Escorts India. With that, let's take a look at all the stocks which are on the radar of our experts. Brijesh, stocks that you like at the moment?
Yeah, there are two stocks are from the Midcap and one from the banking space. So I'll go along with the Tanla solution. This is, I believe this has given a very good range breakout. I would go along at current price. Stop loss for the trade will be 940 and the target would be 1090. This is slightly a bigger target, but then this would be more of a directional trade. Same like Tanla, there is one more directional trade. It's from the monthly time frame. JK paper. This is something which has given a very strong breakout in the monthly time frame. That's a bullish flag kind of a pattern which is forming in JK paper. I believe one should go long at this current level. The stop loss would be 390 and the target would be 550. It's a slightly monthly target, so little bit of longer time frame. And on a quick trade from the trading perspective, I think Canara Bank is one which I'm currently liking. We are observing the call writers are exiting their short positions at 130 level. So I have a sense that Canara Bank sooner or later can test the 130 mark. So I believe one can go long in futures at the current price. The stop loss of 180 for the target of 130.
Okay, our viewers will note that both JK paper as well as Tanla Solutions is not a part of the futures and options space. So those are cash calls, of course. And on the other hand, of course, Canara Bank is something that does trade in the futures and options space. But Akshay, coming to you, stocks on your radar at the moment.
Yes, so both the stocks are from the futures and options space, and firstly is the Federal Bank from the mid-cap banking space. And my sense is that private banks, especially mid-cap bank stocks, will have a good rally from here on. So I'm looking at Federal Bank, which is currently trading around 167, 168, 168.5 is possibly the breakout zone on the price parameters. That was the swing high which we saw somewhere in the month of May. And my sense is, looking at the chart setup, there is a good probability this breakout is happening soon. So buy Federal Bank at current market prices for the breakout I mentioned. The first target would be 176 and the second extended target would be 182. The risk or the stop loss on the trade would be 163. The other trade is from the metals pack, Jindal Steel and Power. Now, if you look at the pricing of Jindal Steel, 1025 is the current market price. Slight consolidation in the 1000 to 1040 zone in the last 4 or 5 sessions, but slowly the stock is building up momentum pace for breaking this consolidation and heading for the upside targets till 1087 to 1222. That's the two targets you should be looking forward to in the short term. Stop loss would be 997 on this long trade.
All right. On that note, I want to very quickly take two stocks which are buzzing in trade before we move on. And first one is Siemens, because it seems like it's picked up steam and it's up around 3% at the moment. Brijesh, any ideas as far as Siemens is concerned at the moment, considering it is already up 3% and we're starting to see some traction return to this one?
I believe the gain what we are seeing today, the 3% gain, is a fresh up move which we can see. And I think looking at the charts and the momentum oscillators and the other technical parameters, its recent high of 7300 mark, 7380 mark, I think that can be retested. It may even go further high, but then somebody who's having a position to hold on the long positions, we can talk of 7400 on an immediate basis on the higher side.
All right. As we speak, the Bank Nifty has in fact conquered 50,200. It's a point that Akshay was making, and perhaps now is around the time where we will start seeing further about covering of shorts when it comes to your specific calls. Of course, at this point in time, of course, things are looking up, and the Bank Nifty has picked up further steam, and a lot of those calls which were sold into will have to be forced out of their own positions. But the other counter that we wanted to talk about is Bharat Electronics. Akshay, the other one, this is the other one which was very strong, of course, until last week, the 4th of June, until the outcome of the elections. And since then, we've seen a correction, and now we're starting once again to see that a little bit of an up move when it comes to Bharat Electronics. Do you think that the risk-reward ratio is still favorable towards longs here?
The risk-reward is not favorable at this current moment for Bharat Electronics, though the stock is attempting a recovery of the lost gains which we saw last week. I believe almost 60% is what the retracement is at the current level of the losses which we saw on the election outcome days. A lot of froth was evident in the PSU ahead of the election outcome. This entire froth cooled off on the election day, and now they are trying to regain their lost glory. So BEL setup is positive, trying to get back to the 320 swing high levels, might be a bit choppy for the short term. So, if you are having a position or plan to build one, keep a slight range in perspective in mind, 280 on the lower end and 290 where it currently trades. Try to accumulate within this range. Not really sure if intraday or very short term, it's going to have a V-shaped recovery, but from a slightly longer perspective, maybe for the next 10-15 days, there is a good chance the stock should attempt its swing highs of 320. So stay invested. But from a trading perspective, not really keen on playing this out, considering the risk-reward payoff which this stock presents at the current level.
Okay, well, on that note, taking a moment to thank both our experts for joining us and taking us through their views in the markets, and of course giving us a handful of trading ideas. Well, but we move on to another big story coming in. The new formed government is all set for its first Lok Sabha session, which will be taking place on June 24th. My colleague Janani is joining us with more details here. Janani, take it away.
That's right. We're hearing from the Parliamentary Affairs Minister, Kiran Rijiju, who tweeted on the platform X a little while ago about the first half or the first session of the 18th Lok Sabha session that is going to be underway from the 24th of June till the 3rd of July. Now, we do know the order of events that's expected. First, of course, the